Welcome to day 2 of Venture and Capital, where we empower innovation, ambition, and capital. Today, we're going to be focused around opportunities in the sectors of property, fintech, proptech, energy, edutech, technology, and funds. As a keynote speaker, we absolutely have a special treat for you today. Today, we're going to be interviewing the co-founder and managing partner, David Andrade, who's from Fat Projects. Now, David is in the process of actually doing a $100 million SPAC on the NASDAQ. Now, for me, I was so excited to do this session because I realized as Australians, we don't typically get to meet some of the faces behind who are the people that are putting these deals together to understand what is the pathway, what is the opportunity, and what that can represent for maybe some of your investee companies, future investee companies, or even some of the companies that you're involved in right now. So that session you're going to absolutely love as we actually break down that entire process of basically building and going to create a $100 million SPAC and what that means. Now, we also have an incredible panel session called Brick by Brick. Now, the entire event, as we know, it takes place, it's been streamed inside the Brella app. And also in there, there's a whole bunch of opportunities for networking, there's for engagement and so forth. Now, the way this day has been structured, similar to yesterday, was the first part's going to be the conference aspect, the presentations, the keynotes, etc., and also obviously the companies presenting, and there's an incredible lineup of companies participating. The second part is where we actually open it up. We've got live breakout sessions, Q&A, etc. As I said, this day is designed for you. First part of the day is all about learning for yourself and content and meeting some of the great companies. Second day is all about engagement, hosting meetings with the companies which you're expressing interest in, and also getting involved in some of the breakout sessions. So, welcome to day 2 of Venture and Capital. Enjoy the conference.
Hi, it's Kylie Davis from the PropTech Association here, and it's great to have you on this webinar talking about technology and brick by brick property development and what we've seen over the last 12 months. I'm joined by Delwyn Selva from MPSS. I'm also here with Robert Bathka from Newground and Jim Castanet from Versailles Capital. So, gentlemen, what we're going to talk today about is what the last 12 months has been like in the property development and investment space. What have you guys seen? Well, how has COVID affected the market and investing in property?
Sure. Shall I kick off with an introduction?
Go. Yeah.
Thank you. So, hi everyone. I'm Jim Castanet, Managing Director and co-founder of Versailles, a funds management company which I established to drive development activities a couple of years ago. Now, I've been developing medium to high-end residential developments and mixed-use developments, in fact, for the last 20 years or so. During that time, I've successfully developed and led, I think, just about over $1 billion worth of projects. I'm an educator, and I founded property development workshops in 2004 to educate people in property development. I'm also the author of the book Build, and I have featured as a guest on Sky Business Real Estate News. And I'm very excited to be here today. Cool. Would you like me to answer the question?
I think so. So, Jim, what have you seen? How's the last 12 months been in terms of property investment? What have you seen? What has transacted well? What hasn't?
Sure. Look, I guess let's address the elephant in the room, if you like. Now, and I'm talking about COVID. So, I believe COVID, at the end of the day, will have a positive effect on the property market. Indeed, I was predicting in mid 2020 that there would be a strong recovery as we live to learn to live, I should say, with COVID. In fact, this is the case. And it's been the case with all previous 5 shock events that have happened since the 1980s, including the share market collapse, SARS, the GFC, etc. Now, back to today, according to CoreLogic, the year-to-date prices for houses to August 2020 which is last month, house prices have risen 23.3%, and units 11.5% in Sydney. Now, nationally, those figures are 17.8% and 9.3% respectively. So I believe the upward trend in prices will continue. I believe not so much because of COVID, but because of the supply and demand equation. And in the short to medium term, there will continue to be a short supply of dwellings, particularly when immigration resumes in full swing. So look, I'm very optimistic about property development, especially residential developments as an investment opportunity. And I've got to say, at Versailles, we are very keen to offer investors an early harvest strategy, meaning high returns in a short time frame to capitalise on those opportunities.
Great. So, Delwyn, just do a quick intro and tell us what you've seen over the past sort of 12, 18 months and how COVID's impacted the market.
Thanks, Kylie. Sure. My name's Delwyn Seller. I'm the licensee of My Property Solutions Sydney, or MPSS. We specialise in property management, and that goes across residential, commercial, and some industrial property. And I think the advantage for that, for the benefit of people listening to this, is that we're in the marketplace on pretty much a day-to-day basis. In terms of, what are our comments going forward? I've got to admit, at the beginning of the process, everyone thought, I think COVID was going to be a disaster, particularly for asset-light property, and we mean residential housing. As it's turned out, it's been exactly the opposite, and it seems to have spurred a drive for people to acquire, particularly residential property. And oddly enough, it's seen an adjustment in the playing field for commercial property. So in the last 3 months in particular, we've experienced a large amount of inquiry, believe it or not, for commercial space, and also for investors looking to purchase commercial property with long-term horizons. To add a little twist to that process, we've recently been involved with some short-term rental companies, and they're seeing an upswing into the future as well. And they're busy out looking for properties to ideally rent or acquire to rent on the basis that they feel there'll be an influx of people back to Australia once the vaccination process has reached its peak. So having said all of that, I've got to agree with Jim. I think the future is optimistic. It's good. I'm as surprised as everybody else, but happier, of course, because I'm a real estate agent, that property is moving forward. The only thing that's a little bit tricky on the horizon is rental yields continue to decline. So I think that's an indication that prices are fairly full. But having said that, certainly at this stage anyway, supply does not seem to fit in with the demand for property.
So Robert, tell us a little, just give yourself a quick intro and tell us what your experiences have been.
Robert Bathke, Associate Director at RCG Newground. We are fund managers involved in various sectors of the commercial real estate industry, so not simply residential, but throughout. What we've seen is that there are both winners and losers in terms of COVID. Losers are fairly well documented. Big retail malls and retail holders, and the clear winner being industrial and particularly logistics. Residential has been another winner for the reasons that have been mentioned before. Definitely seen an uptick in market, particularly in the more recent months, and an increased level of inquiry, and that is due to a large number of factors, some of which are commercial banks pulling back and being more conservative, which opens up a bigger market for us as institutional / private lenders. So that's been our experience.
Do you think that as we look at the market, we're kind of at the bottom now? Because we look sort of down the crystal ball of what's coming. We're about to hit critical mass in the next couple of months around vaccinations. Borders have got to start to open soon by the end of the year. we've got it. You know, I tell you what, when they do open up, we're going to hit the shopping malls so hard because everyone has been so desperate to do any shopping that wasn't just, you know, a quick dash and grab at either Dan Murphy's or Bunnings. What do you think that now, if you're looking at that commercial property market and retail, that now is the time when people are starting to act because we are kind of bouncing along the bottom?
It would seem so. I mean, if you look to Europe and the UK, you know, they've just had their summer holidays, and everyone there seems to have been off all over the world, and so very much an open border as opposed to a closed border philosophy, given that they're out of lockdown and a fairly high vaccination rate. So it would seem to be so. Whether everyone runs back to the malls, I don't know. I think
I'm going.
Well, a lot of people aren't. If you have a look, and I just use the UK as an example because one might say that they're a couple of years ahead, and that Australia might follow a similar path, and they're sitting at 25% of sales being online based, and we're sitting at as far as I know 15%, and so have got a way to go to get up to their level. So there's an element of thinking that says that COVID accelerated a transition that was happening and already in progress. It simply was an acceleration to where we are now. And what that's done is, in our minds, created sort of the winner and loser camps, and changing nature, where we've seen our neighborhood retail centers becoming centers for last mile logistics. And the reason that I say that is because Coles and Woolworths, for instance, will on their click and collect, or they will actually use their stores as their source, and so that's a change that we're seeing.
We have seen a lot of changes through this period, haven't we? And while being locked down is never fun, the change towards working from home, even if it's just some of the time, has been pretty, you know, universally embraced, especially in white collar jobs. Delwyn and Jim, how do you think that's going to impact on commercial property values as we come out of, and commercial property demand as we come out of it?
Well, look, in terms of on the ground, it's, as you know, there's so many different classes of property, it's hard to be specific about it all. But commercial property, high-rise buildings where there's a lot of people, lift access, that's certainly under pressure, because many people have at that stage where they're saying, well, look, if I can do something at home, I will. Employers seem to be encouraging that process as well. There's instances of large commercial development in the city of Sydney where those firms are basically turning around and saying, we'll bring in half our workforce for 2 or 3 days and the other half for the balance. So that's definitely going to impact on those large-scale commercial processes. At the other end of the scale, you've got smaller scale commercial retail, for example, where you've got a single tenancy, a strip shop, something along those lines, and they're really dependent on lease. So if there's a good solid lease, you're going to get a good multiple, a good return on your commercial property. If you've got a lease that's out of kilter with current rentals, and also in terms of its clauses that might be a bit archaic, then you're probably going to see some renegotiations, and I think some values will come down. In residential, none of that seems to matter. People are basically just saying, look, I need a property, I need it now. And it's fear of missing out, I think, that drives the market. And I think the only thing that's going to change that realistically is affordability. And, you know, when it gets to a point where it's not affordable anymore, then you're going to see change. So, again, to echo Robert's speeches as well, it really is a case of winners and losers, and you've just got to be a bit selective about the direction you're travelling.
Jim, what's your view on that?
I'd love to just make note of some of the trends that are happening, in particular with the workforce. Now, there's been a lot of migration from cities to regional areas, of course, mainly due to the COVID effect, but that growing trend and acceptance of people working from home, or anywhere for the matter, is becoming the norm almost. So there are lots of regions throughout Australia, but let's say the more popular ones offer, strong lifestyle benefits like affordability, wide open spaces, good weather, and generally just a less stressful lifestyle.
Mm.
So in New South Wales, the best known regions would be places like Byron Bay and surrounds, Newcastle, the Central Coast, etc., and similar regions in the other states. Now, from an investor point of view, I would be suggesting that we, don't overlook that trend, and certainly the best way to get into those markets is to try and get in early before the demand becomes too overwhelming and indeed prohibitive. And also select those areas that are close to the hotspots like Byron Bay, because obviously they're going to be cheaper while offering the same sort of good benefits. Now, that trend, I think, will also have obviously an effect on an impact, I should say, on commercial property and how that's being managed. But yes, it's all very interesting.
Yeah, and you raise a good point there too, that I heard a great tip recently that the infrastructure you should be looking at, especially in the country areas, is not just road, rail or infrastructure, but is NBN, and looking at where the NBN's going, because one of the great saviors of COVID, or that saved us during COVID, was technology. And obviously I'm from the PropTech Association, so I'm a big fan of it. But what kind of tech did you see helping or being embraced in property investment and in the property space during that COVID period? And how did it help?
Well, I might start this one off. In our particular business, the technology really revolves around inspections and getting into property. And the greatest leap forward in that has been the ability to have tenant inspections and videoing. And that's probably likely to continue even when COVID ends, because there's a high degree of efficiency in that and not having people travelling out and about. And I think the other important thing, which might be worth a mention, is that technology might well play a big part in the way investment in property continues into the future, because if you read the reports, people are inventing things all the time to kill the virus. And if one of those inventions comes across the line and is relatively easy to manufacture and cost effective, I think that will actually be a game changer in the property industry, because obviously people will embrace that. So the answer is technology in our industry, in terms of getting out amongst it. The greatest move has just been able to use the video processor and get that collated back into your software system so that there's records for owners. And that's saved a lot of money, a lot of time. But just as importantly, has brought about better process for the tenant and the landlord at the same juncture.
Robert, what sort of technology have you seen being adopted?
Well, from our side, it really, if you think about what's had the biggest impact, is simply to Delvin's point, being the ability to do what we're currently doing, and not only really the acceptance of this type of technology, and thus a way of working where there may have been a reluctance to do so in the past, and this has become our everyday way of life. It's you're used to having meetings with people, and their kids are walking around in the background now.
Dogs,
and I think
cats.
Dogs, cats, cockatoos. But so that really has, to me, it's been two things. It's been the use of the internet, and internet for, be it online ordering in all the aforementioned categories, Uber Eats, those sorts of things, as well as just being able to work remotely and connect remotely. And so really the main driver there has been access and data access.
So Jim, what are the end buyers expecting now with your developments in terms of technology? I mean, I think the whole buying experience really got changed during COVID, because you haven't been able to do what the industry always told you had to do as a buyer by going and inspecting everything manually and trying to cram all that time that you needed into your weekend or whatever. But what are buyers, what do you think the lasting impacts on buying is going to be?
Look, we all the things we used to take for granted, even things as simple as signing, sales contracts, have gone by the wayside. But on the positive side, our friends in the legal fraternity who absolutely hate technology in a way because they want everything to be done in its original form and so on and so forth. So with contracts and options and all those paperwork, all those legal paperwork that we have to sign, it's actually become a lot easier because it's accepted now that online, online signing of documents is actually acceptable legally in most instances. So where before people used to have to go out and visit one-on-one to get signatures and so forth and do exchanges, we can actually do that all remotely, and that makes it quite easy to do deals. Now, the other thing, of course, is when the consumer is inspecting, I should say, properties. Well, the virtual inspections I actually love more so than having to go out. It's much easier for people to do a virtual inspection than it is to go out and physically, go through each property, and you try to, get to the places at certain times. You've got 15 minutes or 20 minutes to visit it before you run to the next one, etc. I mean, you can do it at your leisure, and if you really like a property, you can dive deeper and get more information before you actually do the deal. So look, again, I think what comes out of these crisis events are some very, very positive things. And as they say, when we need to invent things, because mother is the what's the word?
Necessity is the mother of invention.
Necessity is the mother of invention.
I think necessity is the mother of adoption, though, because to be fair, digital signatures have been around about 15 years.
Absolutely, I would expect that from a
virtual
tech person. But certainly we're seeing that it's happening more and more as we speak.
Yeah.
But look, from an investor point of view, I want to just go back to that. I think people need to understand that the market is very, very well placed, and indeed there should be no fear in my mind because of COVID that we should not be investing. We are currently enjoying unprecedented times when it comes to property investment, and I'm talking here about the lowest interest rates in history. We have unprecedented demand and a lack of supply. We have a population growth that will increase exponentially, as we mentioned before, as immigration resumes in the next, say, 18 to 2 years. I know that the government is planning 160,000 new immigrations per year going forward. We have the most desirable country in the world to live, including some of the world's most livable cities. And yes, we will learn to live with COVID, right? So I'm very optimistic about the property market, and it continues to excite, and it will grow in the short, medium, and long term. So if you're an investor, now's the time to come in.
And one of the things that I think is at that cutting edge that we're seeing in the prop tech space, which is really interesting, that I'd love to get your thoughts on if you've seen them. But we're seeing a whole heap of new tech coming out that looks at different ways to buy or invest in real estate. So that fractional ownership, or even some new platforms that are supporting, especially the smaller property development end, that are allowing you to kind of invest your super funds into, lending money to developers to go out and build property and to make that easier for developers. Have any of you guys come across any of that?
Well, I certainly have. So fractional property investing has become very popular. And I think what's important to recognise in all of this process is that the underlying asset is still what you're buying.
Yeah.
So, and things like fractional investing and methodologies that have been applied by some pretty smart, entrepreneurs to make property more available to a greater mass of people. But the bottom line is always, it is the underlying asset. So the fundamentals of property is still there. You've got to think about location. You've got to think about the rentability of that asset if it's an investment. And you've got to keep, in my mind, an eye to what the future might be in property. And in that space, I think that we are going to see the classes of property separated a bit further. You might see that newer property might become more attractive than older property because it might mean more compliance with things like COVID and health regulations. and some people might gravitate to that because they might feel it's safer. Then you might have that class of property in the middle where those things can be added through forms of technology. So if you're investing into property, no matter the method, be it fractional, be it as a direct purchaser, or be it through some sort of aggregation process in a managed fund, you still got to think about what is your underlying asset and what your horizon is for investment. And I think to the point of both everyone on board, I think the risks are fairly low if that time horizon is medium to long term.
If I can chime in on that. Look, traditionally, Australia has provided many ways to invest in property, including, as we all know, the long-term buy and hold strategies using, negative gearing, etc. So investing generally in property is a relatively safe strategy, as we know, to build wealth. Indeed, about 80% of Australia's rich listers, as you probably know, hold their wealth in property. What is not so well known is that, that wealth, or a lot of that wealth, is actually achieved by investing in property development. We know that in the major capital cities and the regional areas, the federal and state governments are investing loads of money in infrastructure to encourage developers, in fact, to take up development opportunities in order to meet future housing shortages, which we all know is already happening. So these are growth areas that are well supported by transport generally. In most cases, these areas have been rezoned for much higher densities, high rise. But however, investing in property development has always been regarded a bit of a risk. And I want to address that, being a property developer. And the reasons, obviously, are these. It can take up to 4 or 5 years to complete a project. And if you're an investor, this can be of concern. And in doing that project, you have to take the risk of finding, the right site at the right price. You have to go through what can only be described as a very convoluted planning process. You have to do the construction, and of course, the market can turn during the project lifecycle. So there are some risks there. So what we've endeavoured to do, and I think we've found the solution in Versailles, is that we provide quality, relatively low-risk investment opportunities for our investors in our projects and still achieve very high returns. So how do we do this? Well, we do it by doing only the front end of the development process. That is, we do the site acquisition, we do the planning approvals, and indeed, we sell the site to another developer to build on receipt of the approval, on receipt of the DA, and pay out the investors. So there is no construction risk, there's no debt funding, there's no marketing risks to sell the apartments, and the whole process takes under 2 years. So it's a way to join those rich listers in that they used to have all the opportunities in property development, and now we're making it much more accessible to our wholesale and indeed sophisticated investors. So look, if you want more information or you would like to see some case studies, please book in for a one-on-one and we'd be happy to help.
Sure. Well, we're seeing too some really interesting tech coming out that is actually doing that site assessment and, and taking lots of and planning and pulling together all of the council databases so that you can actually upload plans and see quite quickly if things are compliant or what would make them compliant. Robert, what's your experience? Because you mentioned big data before. What's your experience been in adoption and maybe issues around data sharing?
Not really a lot of experience with respect to that. I mean, if you have a look, we deal with the institutional and wholesale investor market, and so it's a fairly sophisticated market and deals with large projects. So you would often have a professional team that are set up and running those processes. So not something that I can comment on, but I would, if possible, like to, Kylie, come back to one of your earlier questions, which just really spoke about, how do you invest? Are we seeing abilities to invest? And I think that the first thing is I'd like to agree with both Jim and Delwyn that property is a good asset class. I mean, it's got good tailwinds associated with it at the moment, and any of the headwinds that one can think of apply not only to property but also to all other asset classes. So you can't say that the one is distinct from the other. And property, as Jim and Delwyn have said, is performing well. With respect to exposure to property and the ways to get exposure to property, there are a number of those, and one mechanism would be through direct ownership. Another one would be through a debt platform, where another entity takes the developer essentially takes the first risk loss, or the first loss risk, should I say, and that enables an investor to invest in effectively the debt and become essentially the bank. And there are a number of those available to both wholesale and retail investors in order to get a foothold in the property market.
Okay, fantastic. Well, look, gentlemen, I'm sure we could talk about this all day, but I think we're going to have to call time there. Thank you so much for your time, Delwyn, Jim, and
Pleasure.
Robert.
Pleasure.
Thank you.
Thank you very much.
The venture capital market is notorious for its illiquidity. Unlike that of public markets, investors don't have that power to buy and sell with speed and transparency. As an investor with existing equity in a company, this means 1. It's harder to restructure and rebalance your portfolio as you would in public markets, and 2. It's near impossible to liquidate equity ahead of the business's intended exit. Essentially, your cash is stuck in stocks. On the other side of the coin, there are investors who are looking to enter later stage opportunities. However, those opportunities have already closed their doors to funding rounds, and if they do reopen, they're usually reserved for venture capital firms, existing investors, or private equity firms. This means there is a high and expensive barrier to entry. So, with both these problems in mind, we have worked to launch the WY Capital's secondaries platform, utilizing our network of 30,000 plus high net worth and sophisticated investors and combining that with the CRIISP software, an underlying technology that helps streamline and facilitate these transactions. And it's already working. We are open for business and our clients are well underway in establishing their own secondaries markets. So, if you're looking for options to sell existing equity in a company, or you want to see our most recent catalogue of secondary investment opportunities, feel free to contact us via the email on screen or reach out to us via the Brella booth for the remainder of the VNC conference. Hi, and welcome to day 2 of the VNC conference. We've made this day all about property, funds management, and listed opportunities. So sit back and watch this array of investment opportunities ready to engage with you if there is any interest. Feel free to schedule a meeting with the company reps via Brella or their deal rooms. Enjoy.
Hi there, I'm Gary Blom and I'm the Executive Director of National Property Data. Let me start by telling you a little bit about our company. In August of 2020, we acquired Red Square from the Estate Agents Cooperative. Red Square was the data company for the EAC, which was formed in 1960. EAC was formed as a cooperative of real estate agents in New South Wales, and over many years collected property data from all of their members. And in 1987, launched their data business called Red Square to the market. In the early 90s, they then started offering that data to valuers, property developers, and other parties. What we have now is a true alternative to a very outdated market leader, a bit like the taxi industry. And the investment highlights are clearly that we have a growth SaaS data subscription model. We have recurring revenues. We have very strong cash flow and margins, and more importantly, a very highly scalable business model. I think we all understand that data is now the next oil. Without doubt, the largest companies in the world are now data companies. IBM, Google, Facebook, Amazon are all data companies. And that's why the global market has grown from 70 billion in revenue in 2015 to 132 billion in 2020, a great market to be involved in. If you look at the Australian property data market, which is approximately $350 million, there's only 3 real players in the market. One, the largest one, and a very large one being CoreLogic, which used to be called RP Data. The second company being Pricefinder, which is owned by Domain, had revenues of around 25 million. And at the moment, we're a very small number 3 with revenues last year of $1.5 million. The big difference is that these days, property buyers and sellers expect access to more than just data alone. They expect to get instant access as well. So our main objective and purpose is that we tailor real estate data to be more accessible and relevant to all of our customers. So what we offer is now an empowering property professionals to make smarter decisions faster. And the way we do that is that we have clearly now the best property data platform in the market. This platform was not updated for 8 or 9 years, and we've spent the last 12 months and a lot of money in now making it the best property data platform in the market. The company has always had the best quality data, and that's why valuers and property developers prefer to use our product over our competitors. And clearly, we've always had the best local support. All of our support team have been with the company for 6 to 10 years, and they are data professionals, whereas our competitors use offshore support, which is predominantly just telephone support. So what are our competitive advantages? We have very clear pricing, one package, no matter where the data is for, which state it's for. We have a very modern design, new platform, which was updated and launched in June of this year. We have 40 years of quality data, and the data is perceived to be the best data in the market. We have a very singular search where you can simply, like Google, enter one address and get comprehensive results on that property. We have a branded report, which is ideal for real estate agents to simply print out that report and deliver it to a potential seller of a property. We launched last month our automated valuation model, which I'll talk about later. We've also launched and have the leading mapping software platform in the market. And more importantly, our new platform is very easy to navigate and very simple and fast to get results. So we have basically 4 products. We have property data, we have integrated mapping, property listing, and automated valuation. And I'll talk a little bit about each of those a little bit further. All of this is accessible through this very simple one-line search, a bit like Google. All you have to do is put in a property address or an owner's name or a suburb, and all the information, all the data about that is available through this very simple search. Once you go into the data, we have extensive property data, currently with lots of property records, current market information, and property imagery. This will be expanded exponentially over the next couple of months as we've now been approved and have signed to take on the Queensland data from the government and the same for Victoria. So our products, as I mentioned earlier, includes mapping, and we are known to have the best mapping capability in the market. Valuers, property developers all have stated that our mapping is far superior to our competitors. Like realestate.com and Domain, we also have our own listing portal, and this listing portal, which has been predominantly New South Wales but will be expanded nationally, currently has over 60,000 properties for sale or for lease. And our automated valuation model, which was launched in June, is quite unique. It uses market intelligence and it uses machine learning to automate a valuation on a property. It does this by looking at 10 similar properties in an area, and using machine learning is able to then create the automated valuation, and more importantly, it is customizable. This is the only automated valuation product in the market which allows you to customize it. Our potential customer base is predominantly real estate agents, of which there's roughly 47,000, property developers 46,000, and valuers. Our total customer base is 97,000 at the moment. One of our directors and shareholders, Rob Flux, is the managing director of the largest network of property developers. They currently have 12,500 clients, and Rob believes that what we're doing now is a true disruptor in the market. Our customers, existing customers, include some of the larger real estate agencies such as LJ Hooker, Ray White, Elders, First National, as well as some very big valuers like Acumentus and Optium. Outside of those markets, we also market our data to TAFE and the Transport of New South Wales. In June of 2021, we acquired Australia's oldest online real estate auction business. This is the only product available in the market that is actually legislated to be used in every state of Australia. Timing for this was perfect. Now that with COVID, many, many more auctions are being done online, and we're the only one that has a true product that can handle both online auctions as well as best offer or for private treaty. We expect revenue to grow exponentially over the next couple of years. Our revenue for the last 12 months was approximately $1.4 million. It will grow to $14.5 million in 23-24. Most of that growth will come from our expansion into Queensland and Victoria, and us adding additional sales and marketing in New South Wales. Up to the time when we bought the company in 2020, the Red Square or the EAC had spent no money at all on marketing or selling of their platform. So we're spending approximately $1 million in marketing over the next 12 months in building our customer base. As you will see from the financial summary, this is a very profitable business, and our margins are very high, and therefore by the time we hit year 3, we should be dropping around 35% of our revenue to EBITDA. We're looking to raise a total of $3.75 million in this round. We just completed our Series A in July of this year, where we raised $1.55 million. That was oversubscribed. We were only looking to raise $1.25 million. And now that we are ready to move into the other states, we're looking to raise a total of $3.75 million. Of that amount, 1/3 is already accounted for by a large strategic investor, and the use of funds will be predominantly additional acquisition of data in the other states, being Western Australia, South Australia, Tasmania, Northern Territory, etc. We will continue to grow and expand our technology. We need to add sales teams in Victoria and in Queensland and enhance our sales force here in New South Wales. And we're spending at least $750,000 to $1 million on marketing and customer acquisition. In addition to that, obviously, there are some standard closing and legal fees. So in summary, we now believe that we are a true competitor to the market leader. We are an alternative, and the best analogy I can use is that the market leader is a bit like the taxi industry. There hasn't really been an alternative up to now, and now with all the work that we've spent on the product over the last 12 months, we are a true alternative to the large competitor. So thank you very much.
Hi, my name's Delwyn Seller and I'm the principal of My Property Solutions Sydney, or MPSS for short. I'd like to summarise our investment opportunity for investors. We're offering the opportunity to earn regular quarterly payments from our established company in Australia's largest rental market. Let's talk a bit about those markets. Most of you are familiar that private landlords can rent their property throughout Australia. You may not know that roughly 30% of all Australian households are in fact renters. And this continues to grow over the last 2 to 3 decades and most likely into the future. There's a second market that we need to consider, and that's the rise of self-managed superannuation. Australia boasts the 4th largest pension market in the world, and about 15% of self-managed superannuation fund trustees are now investing into some form of direct property, and that continues to grow. There's a third market, which you're probably not very familiar with, and that is the market that's internal to the real estate industry. This is the opportunity where an existing licensed real estate agent can purchase the rent roll or the property portfolio of properties that they manage internally through the licensing process. This market clearly only exists for those people within the industry. To make that purchase more effective, we need to consider some of the legacy issues that have been involved in the real estate industry over the last decades. And the first of those is a very simple one. Most real estate agents are focused on sales, and that's what their principals do. They go out and sell property. Their property management business is usually run by a property manager, and the cost of property managers has been rising predominantly over the last 5 or 6 years as more and more people have gone out into sales and the ability to find a good property manager has become harder. We've solved that issue through a new method and a methodology for recruitment. Another past issue has been what we call area focus. And that is based on the concept that to grow your real estate business, you needed to have multiple offices. So if you had a business in Manly, a real estate business, that you might feel to grow that business in Mona Vale, you'll need to establish another office with the round of expenses that go with operating that new office. This has been changed by the improvement in technology that it can now be applied to the real estate industry. Before we go further, I'd like to talk a bit about our team. We've appointed our CEO from within our business, and she's had basically 15 years of experience and now runs the business on a day-to-day basis. This means that myself is able to go out into the marketplace and focus on acquiring new business through the rent roll process and thereby scaling our business up into the future. We also appointed about 3 years ago a new business leader. She has been with us and bringing in new business opportunities over that time. And this is important because it gives us another string to the bow in that we're not just relying on the acquisition process, we can also grow our business organically. Only a couple of months ago, we appointed our communications officer, and this is in line with our process to grow our investor base. And our communications officer will be in touch with our investors on a regular basis through newsletters and other communications as we deem necessary. I'd like to talk to you about the investment opportunity with MPSS. Firstly, you should know that if you make an investment with us, that money will only be used to acquire new income. So we're not putting it towards managing existing expenses or increasing or managing our costs. We're using it only to acquire new income. Our existing business base covers all our fixed expenses and allows us to now foster this process of growth into the future. We've solved the legacy challenges over the last 3 years that are based in real estate, and I'm proud to say that we did that by running a pilot program and integrating 2 rent rolls into our current business over the last 18 months, which has been successfully done. What's our future? We want to grow our business within the next 5 years to be the largest rent collection business within Sydney. We intend to continue to take advantage of the opportunities presented by new technology and keep our costs manageable while growing our income. Obviously, we want to meet new landlords, and to do that, we've instigated an advertising and promotion campaign, which will launch towards the end of this year. What's the process of investment? An investor with MPSS will receive 7% per annum in interest, and that interest will be paid quarterly in arrears. Your capital investment will be returned to you at the end of 2 years from the date you've made it, and there will be opportunities to convert that investment, if you thus desire, to equity within our business. We're looking for a minimum investment of $5,000. I'd like to thank you for your time in listening to our presentation at MPSS. I invite you to please click on to this and scan the below barcode to get to our website, and I look forward, if needed, to speak with you about our investment opportunity. Once again, thank you.
Welcome to the Propio capital raise presentation. My name is Ray Christopher, I'm the CEO. Propio is an award-winning fintech company, and we enable global investors easy access to UK property-backed investment opportunities. So we look to target global investors who want to make an impact, and we take their capital and we create property loans to fund ESG-driven UK housing development for small and medium enterprise house builders and developers. By ESG, I'm talking about environmental, social, and governance. So at Propio, we solve multiple problems. The first problem we solve is providing market access and ESG investments for high net worth investors. We know that high caliber, sophisticated UK real estate investment strategies with ESG-driven requirements are only available to institutions and the super rich. Market access is therefore a problem. We uniquely provide the platform that originates ESG-driven institutional grade residential real estate opportunities to serve a global pool of high net worth investors in a scalable way. This is all underpinned by a very scalable technology platform, and we provide global investors access and exposure to UK property markets and residential real estate as an asset class. But it's not just investors. We help solve the problems for borrowers as well, property developers and SME house builders. Our team combines technology with years of property experience to attract global investor capital across a range of UK residential property-backed loans. We co-lend alongside senior debt providers, utilise their underwriting processes, keeping our in-house costs to a minimum, and we only lend to within about 75% loan to development value thresholds. Our own ESG scoring methodology also feeds into the borrower's interest cost setting process. We help investors really make a difference and become impact investors. We work with each SME developer to improve their ESG credentials over the life of each loan. We score, advise, and mentor each SME to agree and create an evidence-based ESG improvement plan. We monitor the plan and an improvement from the initial ESG score by delivering on the plan results in a reduction in the interest payable on the loan. In this way, investors can directly influence borrowers' behaviour in the true sense of impact investing and become a force for change. We know ESG investors accept a lower required rate of return. This enhances our proposition. Research by MSCI, BlackRock, Bloomberg, and many others highlights ESG investors are happy to accept a lower rate of return given the environmental or social value generated simultaneously. We also know that risk-adjusted return analysis has also shown that ESG funds are outperforming traditional assets. So we use this fundamental principle and pass on part of the margin adjustment in the form of lower financing costs to borrowers, thereby outperforming all of our competitors. In doing so, our net margins are increased, but more importantly, we will attract a growing and disproportionate market share. And evidence shows that high-scoring ESG companies tend to be more resilient businesses with superior share price performance. They attract cheaper capital and have higher staff retention and more fulfilled employees. ESG just makes good business sense. Our own proprietary ESG scoring methodologies adopt best practice from market leaders such as the global rating agency Standard & Poor's and Moody's, and also MSCI. But we're building upon an already established business, tech platform and investor base. In the past, we've already raised and issued property loans of nearly £15 million, delivering an average return of over 6% with zero capital loss. This has allowed the completion of 59 new homes across 19 projects. And to date, we have over 1,100 investors. So our previous traction in the market is being utilised to create a higher margin, high growth, more efficient business that appeals globally to impact investors wanting exposure to UK residential real estate. And we've had plenty of traction in the trade press and the national broadsheets too. Sometimes in our industry, deal origination, finding good opportunities in the property markets can be a problem. However, at relaunch, we can immediately leverage the deal flow of two partner established businesses. They are Fruition Properties and Pivot. Fruition is a provider of airspace and residential development and taker of gap funding capital from Propio, and Pivot is a provider of lending, credit valuation, and scheme appraisal expertise and loan origination services to us, and taker of gap funding capital from us too. So from day one, we have an immediate pipeline of opportunities to present to you. Why ESG? Well, we know that investment demand growth is a global phenomenon. Institutional investment in ESG funds and products is rising quickly and is the fastest growing theme in the global capital markets, propelled by retail demand too. The bottom line is it's going to happen to us, so we are leaning into ESG and being ahead of the curve. Whether it's driven by policymakers, whether it's driven by the cabinet, boardrooms of governments, asset managers in the capital markets reallocating their own assets, or from activist shareholders in the corporate space, or even from the bottom up, from individuals marching with their feet and with their wallets, deciding where their investment capital is going. Turning to the financials, our new business plan shows that Propio will show its first profits and net positive cash generation by year 2. The business plan has been put together conservatively by reference to other peer-to-peer lenders, despite us having a higher margin business and growth potential. Remember, much investment has already been completed in developing out the tech platform, marketing and early capital raise costs, and our 5-year projection sees the loan book rising from 1 to 2 million this year to 50 million, driving revenues of over 10 million, a net margin of 42%, generating profits of just over 4 million in year 5. In terms of valuation, whilst we have deliberately not been writing new business for the past 12 months during COVID, and as we reposition ourselves away from traditional P2P lending, we've already raised property-backed loans of nearly 15 million, some of which is still current, originated a deal pipeline working with our partner companies, built out a tech platform, attracted hundreds of investors and lenders, and developed an award-winning business. As a result, looking at comparable multiples, DCF analysis, they all point to a Propio valuation of £5 million or above. Turning to the team, I have over 30 years experience in international corporate finance. I've managed global loan portfolios and treasury teams, project finance and residential development. Latterly, for the past 12 years, I've worked in UK housing. I've led over £10 billion in transactions and investment, overseeing the construction of nearly 10,000 new homes built in the public and private sectors across London and the South. I'm also on the board of a housing association building 300 homes per annum, and I chair the Treasury Committee. I have a board who have broad expertise in lending and residential property development, and between them have amassed over £750 million in transactions and building 3 successful property ventures. We're also advised by an ex-MD and global head of HSBC. Manny, Parol and Shahil are all founders of the company and major shareholders. So they ensure the governance of the organisation and they ensure that I execute the business plan. Finally, bringing it all together, the investment offering highlights, we're looking for £250,000 to relaunch a high margin, high growth business for 5% of the business. We are now attracting existing investors and new global high net worth investors seeking exposure to the UK property opportunities. The relaunch is a repositioning of an existing award-winning fintech, and we now seek to attract impact investors globally who care about ESG principles and who wish to become a force for positive change. Our platform uniquely solves the problems of poor UK market access and finding ESG impact property investment opportunities for high net worth and sophisticated investors, whilst matching SME developers seeking more efficient, lower cost development finance. We know ESG investors accept a lower required rate of return. This enhances our investor and borrower position, allowing us to provide cheaper finance than the competition whilst enhancing our margins and growing market share. The new capital will provide liquidity to grow the business for 2 years until such time as operating cash flows can then self-fund our operations internally. So in summary, we invite investors to subscribe for shares and also to invest on the platform, all before the first property deals are placed in November 2021. Thank you for your time. I've left my contact details on the final screen should you have any further questions. Thank you very much for listening.
Hello, I'm Robert Stanley Turner from Box Commercial Real Estate. I've been selling investment real estate for, well, 35 years. And over that time, I've noticed one thing about really successful investors. The most successful investors I've ever dealt with are the ones who have locked in reliable income streams. Today, I want to offer a method of building a reliable income stream. It's called co-investing. First things first, so what is co-investing? Well, co-investing is when a group of investors pool their resources to buy a property, each one of them having a share of that investment. It's that simple. So let's look at a few of these investment downsides of buying your own investment property. For a start, it takes a big financial commitment to buy a property on your own. That can mean, depending on the cost of the property, you might only hold one or a small number. A small number of property leads to a portfolio that's not very diversified, not by sector or by tenant or by geographical area. It's time consuming to find and acquire good investment properties. And once you own it, it can be labour intensive to manage, requiring expertise to solve operational issues such as tenancy and maintenance problems. Also, smaller commercial properties can be lower in quality, and along with that, performance can be underwhelming. Co-investing can overcome many of these issues. Now, let's talk about the advantages of co-investing. It's more affordable for a start because each investor can begin with as little as $50,000. And because it's more affordable, you can tailor your own diversified portfolio by choosing properties that suit your needs, considering metro versus regional by tenant groups, length of lease, or market segment. Could be industrial, could be retail, could be storage, could be office, etc. Next, you don't have to go out and find the properties yourself. They're presented to you in an investment proposal, so you can easily see if you're interested or not. The proposal will give you time to do a thorough assessment. Co-investing in a commercial property is also a passive investment, so it doesn't interfere with the other demands on your time. And the investment managers are financial professionals, in many cases ASIC registered, because you have other investors joining you. The properties will probably be larger and better quality. And best of all, you'll have a regular distribution, typically of between 7 and 9% per annum. So in summary, the economies of scale of co-investing gives investing leverage. I want to stress again, the number one advantage of co-investing. Co-investing provides reliable income streams. Reliable income streams are, in my view, the best way to build wealth. There are two different types of co-investing structures that we deal with. There's the small real estate investment trusts, or REITs, typically include around 5 to 50 wholesale investors with an acquisition price starting around $10 million. They're managed investment trusts, which means they're ASIC registered. The other kind is a straight syndicate. This is typically for around 10 or so investors with generally a company structure where all shareholders become directors of the company. I'm delighted to talk about these different structures in more detail and discuss with you what's right for you. Here are some historical examples of some previous commercial properties that we've dealt with. They're good examples because you can see the kind of diversification you can build in your portfolio. The first is a Brisbane metro office with a lease to Woolies. The second is a club in Pakenham, Victoria, where the tenant is a sporting club that's 100 years old. The third is a cool storage warehouse in Yatala on the Gold Coast. Cold storage has been booming over COVID. That has turned into a cracker of an investment. For a little more detail, let's talk about this case study as an office block in a business park in Mulgrave, Victoria. This investment has sold now, but it produced an IRR of 15% with distribution of 8% on the way through. I like this investment from the moment I saw it because it was multi-tenanted and it's situated in a high growth zone in southeast Melbourne, near Monash University. The property was sold earlier than originally planned because the investment managers saw an opportunity to capitalise on the increased value, so they sold it in a fantastic deal. All the investors had to vote on this before it was sold, of course. Now, I want to talk for a moment on the role that I play as box commercial estate agents. The first thing that happens is a fund manager will ring me and ask what I think about the property they're considering acquiring. I inspect the property, which can be anywhere in Australia. I looked at the properties from Darwin and Cairns to Adelaide and Perth and all points in between. I'm a real estate agent, so I look at things through a different perspective than the fund manager. I think it's vital to have a third party with boots on the ground. I see property so I can answer the questions that investors have about things like traffic flow, tenancies, general upkeep, and specifics about the surrounding area. Then it's my job to feed back my thoughts on the quality of property and what investors will think about it to the fund managers before they commit. Then if I like it, I'll offer investors to the fund managers as soon as possible. If I don't like it, I won't recommend it. I'm the property specialist, not the finance guy. So it's my job to liaise between the fund managers and the investors. I'm the one who inspects the property, so investors don't have to. I'm also the one who asks the hard questions, again, so investors don't have to. Sometimes investors like to remain initially anonymous to the fund manager. I can certainly help with that before any commitment is made. Here are a few of my notable clients. A lot of you will know them already. And here, a little about me, for some reason, my right eye. It's enough to say that I fell in love with property when I was 18 years old. I'm certainly not 18 anymore, but I'm still crazy about what commercial property can do. I'm a licensed real estate agent, and I'm a principal and director of Box Commercial Estate Agents. If you'd like to talk about co-investing or commercial property in general, please call or email me.
Hi, I'm David and I'm co-founder and CEO of CrowdProperty Australia. CrowdProperty is a specialist marketplace lender bringing together wholesale investors with exclusive small property developments. I'm excited to say since launching here in May, we've attracted over 100 million of project loan applications, proving there is real demand here. We are property people lending to property people, and yes, there are other lenders out there, but no one I've found combines CrowdProperty's deep property expertise with our proven scalable platform. And importantly for you as investors, we've done this before. Personally, I've successfully founded and exited a PropTech business. I went looking then worldwide for a solution to help my accountant scale his business. He was building his by looking to protect his wholesale clients' investments by favouring investing in small, high quality, value adding residential property developments over putting their money into riskier stocks and shares or leaving their cash in the bank. Today I'm more excited to be working with the founders of CrowdProperty, who have been focused on building a market-leading business for over the last 7 years, and we're now benefiting from all their IP and experience here in Australia. Our proven scalable platform has delivered 100% track record of investment returns for over 15,000 investors. So, what is the problem we're solving? Well, we're solving real pain points on both sides of our platform. The banks are failing small property developers. They do not receive the speed, ease and certainty they're looking for, all of which are pivotal to the CrowdProperty proposition. Getting back in finance, as many of you probably know, is a complex, slow and expensive process. There's a complete lack of transparency with hidden fees and overheads and lack of access to anyone who understands property. And that's why I love these quotes. These are real quotes which have come from our property developers. And you might say, look, banks might be cheap, but it's a higher price you pay in the end, or nobody understands property. I hate surprises, there were many, we can go on. On the other side of the platform, Australian investors are seeking better returns in this low interest rate environment. And all those reasons I was working with my accountant stand true now. There's also a real cost to direct investment in residential property, and that's ever increasing at the moment. This problem is compounded for self-managed super funds looking to invest in asset classes they know and understand, like property, but also trying to avoid the concentration risk found by investing in single property assets. think last year the ATO sent over 19,000 letters to trustees advising them of this very risk. So the solution? Well, the solution is very simple and profitable as a result. So we want to build a direct relationship with the developer, cutting out all the middlemen clipping the ticket on the way through, and that allows us to pass the savings back to our investors like you. And the platform? Well, the platform just allows us to scale. And the exciting thing here is if you look at those top 3 projects, we've not cherry-picked them. They're just examples of any project in the last year. You've seen over 2,000 lenders coming into each project on the UK platform and funding it in less than a minute. That's right, less than a minute. That's how many people are trying to access these projects. So we've funded 3 already in the UK, those bottom 3 in Australia rather. And we've already generated $235,000 in revenue. We've got a small, experienced and focused team, and we're very experienced in property development. Daniel He, our property director, has his own experience of running developments up and down the eastern seaboard of Australia. Tony Zulli brings, I think, 30 years of experience in the financial services industry. We met when he was responsible manager for the investment fund I was talking about. And we also benefit there from the UK development team, their marketing team, as well as all the grey hair on the investment committee. So speaking of which, amongst our board and investment committee, we've got over 100 years of property development experience. We're also building a great advisory team around us, very successful people. I can't name them all now, but across marketing, finance, people, technology. And likewise, we've got some great industry partnerships which will allow us to hit the ground running and are going to allow us to scale over time. The good thing about this business, unlike my previous prop tech business, it does not need large amounts of capital or high sales volumes to be very profitable indeed. So, CrowdProperty has a repeatable, successful business model to follow. We have full access to 7 years of IP and learnings from our UK business, and you'll be investing in a business with the rights to expand in New Zealand and Southeast Asia. So we're seeking strategic investors who can help us unlock diverse sources of capital. We're raising $1.25 million as a minimum on an $8 million pre-money valuation. And just to give you an indication of what it could look like, our seed investors in the UK are already sitting on a 29x return, on paper at least. I'm looking for investors who can see this opportunity that I saw to bring CrowdProperty to Australia, and for people who can help us unlock diverse sources of capital to fund those projects. This is a unique chance to invest in the early stage of a business that's already proven successful overseas. We have further de-risked it with a very experienced local team, not just in property development, but in scaling marketplace businesses like this one. Now, let's talk about the opportunity to diversify your investment portfolio with high-quality first mortgage secured property project loans. All projects have been through an extensive 53-step due diligence process, including being challenged by our investment committee before they reach the platform. This is the latest project, which is a 20-lot subdivision in the Adelaide suburb of Salisbury Heights. The first raise of $1.4 million has already been funded through the CrowdProperty platform to assist the developer with settling the land. We like this project for a number of reasons. All the approvals are in place and the subdivision has commenced. It has an experienced developer who's done an excellent job to secure a centrally located site that is really the next logical place for first home buyers looking to build their family home. In fact, Fee plans to retain one lot to build his own family home, which is always a great sign when the developer wants to retain and remain on site. He has already secured 11 pre-sales, and in summary, this is a 20,000 square metre subdivision with an independent valuation of an end sales value putting it just under $6 million. We will make available a total loan facility of $4.2 million over a 15-month loan term. There are no investment fees and the target investment return is 7% per annum. Let us help you diversify your portfolio of high-quality, value-adding property developments, always secured by a first mortgage. You can invest knowing that project loans have been through an expert due diligence process, and our team has the capability to step in and work out a project in the event of a default. You can browse on our site or set and forget your monthly super contributions. It's up to you. Or make an equity investment and you could join an awesome team that is following a repeatable business model already profitable overseas. Either way, don't delay to get in touch with me. You can reach us through the CRIISP platform or go to crowdproperty.com.au. It's free to browse and it's free to invest on the platform. Thank you very much.
Hello and welcome. My name is David Fitzgibbon and I'm the Operations Director at a company called AltX. Firstly, I'd like to point out that the AltX investment proposition is very different to some of the other businesses presenting with Wholesale Investor. Please note we are not seeking seed funding, but are sourcing potential investors who are looking for stable returns and regular income with security. AltX is an alternate investment platform offering wholesale investors the opportunity to access and invest in private real estate debt. We've been established since 2012, and I'm proud to say, having come from humble beginnings, we now have a team of 48 people covering a vast range of skills, which include finance, construction, sales, technology, project management, and loan origination. AltX offers investors the opportunity to invest in either managed real estate debt funds or individual loans via our unique investment platform. Typically, all our investments on offer are short-term by nature, ranging from 6 to 24 months, and are secured by first mortgages across either residential, commercial, or industrial property with LVRs up to 65%. The AltX platform allows investors to create an account, view deals on a daily basis, and invest with the click of a button. We publish anywhere between 8 to 10 deals per week, which can be accessed via our simple self-directed platform. In order to invest, you'll be required to complete 2 simple steps, which includes setting up an investment entity and verifying your status as a wholesale investor. Yields offered range from anywhere between 5 to 8% per annum, depending on the risk profile of the deal. At the lower end of the risk curve, you'll typically find loans that have more of a focus on the strength and cash flow of the borrower, what we call full serviceability loans, which offer investors yields between 5 to 6% per annum. Around the middle of the risk curve, offering yields between 6 to 6.5% per annum, are our bridging style loans. Often these loans have a component of prepaid interest and essentially alternate income shorter term style loans. And at the higher end of the curve, around the low to high 7% per annum, we have our development loans. All our loans are subject to our strict due diligence processes, and only when we are satisfied the deal meets our stringent checks, we approve and settle the deal. It's important to note, we pre-fund every deal. What this means is that we settle and fund every deal with our own capital before we offer it to investors on the AltX platform. On most occasions, we also retain a portion of each deal. So what this means is that we become an investor in the deal with every other investor on a pari passu basis, meaning we rank equally with every investor. Having skin in the game definitely aligns our interest with other investors, and from the feedback we receive, is very comforting and a point of differentiation that AltX provides. I think investors really appreciate the fact if something does go wrong with an underlying loan, we have our own capital invested and are willing to roll up our sleeves and commence the necessary action to recover funds. One thing I can say in relation to this point is that we have now written over $2 billion in loans with 100% of investor capital and interest returned. That is nil losses. We also have over 900 investors registered and active on our platform to date. We're very proud of our track record and it highlights the strength of our team and processes we have in place. The emergence of investing in real estate debt is definitely more accessible via AltX, and over the years has become an important part of a balanced portfolio, providing a unique combination of regular income with low volatility and security. If you're interested in investing in real estate debt and are looking for a provider with a strong track record and experience in the market, then please reach out to any one of our experienced investor relation managers. Feel free to send us a request to join our CRIISP deal room, and either Tony or Michael will be in touch and happy to answer any questions you may have. Thank you.
Hi, I'm Paul McIntyre, Investor Relations Manager at KD Funds. KD Funds is a new development-focused mortgage fund, lending exclusively into quality Sydney metro property developments. We're veteran specialists in Sydney property and experienced in lending across every density class, ranging from land subdivision to townhouses and apartment projects. Our focus is on a portfolio designed for a post-COVID world. We're inundated with quality projects, but we're very select in who we work with. We take a holistic approach across the developer, the project, the market supply-demand dynamics, the builders and subcontractors, the legal and financial risks, and the long-term fundamentals of the project. And while every development carries risk, it's how you navigate the unexpected that dictates your success. We believe the development sector is attractive because post the APRA investor loan slowdown, new building regulations, overseas buyer restrictions, and now COVID-19, the market is on uncharted territory where experience and vision will bring both short and long-term rewards. Bank lending criteria is also restrictive, often around minimum pre-sales, which is simply not possible due to FIRB restrictions and local buyers' wariness of off-the-plan sales. Quality Sydney projects are unfunded because banks prefer lending to pre-built dwellings and cross-collateralisation of the family asset. But the market is changing. Opportunities are now opening up to a wider range of investors, including sophisticated investors. The supply-demand equation in specific sub-market niches is strong. Land bank projects that should be brought to market for maximum revenue realisations are now becoming available. The advent of fixed income debt, the arrival of global credit players and family offices are about to bring a velocity of cash to the industry. Quality deals will be grabbed and funded. In the past 12 months, we've deployed more than $30 million with multiple distributions and repayments to investors and borrowers with no events of default. We are building a strong deal origination pipeline across every residential density class, ranging from land subdivision to townhouse and apartment projects. We target a very specific mid-sized market of between $5 and $30 million per transaction size. This is a category often too large for the small private lenders that are charging double-digit rates, and it's too small for the low-cost institutional private lenders that have entered the market. Our critical difference is our substantial manager's own capital investment, fees that are only payable upon capital return, and a focus on strong first mortgage securities. Fundamental to our success is our commitment to strong partnerships with leading bank panel valuers and quantity surveyors, and architects and engineers with real experience, and lawyers who are in the property industry. Australia's national property market is now worth $7.4 trillion. Sydney has the largest national value and is also the most liquid and stable property market in Australia. The New South Wales government is heavily invested in building new infrastructure through a 40-year plan. That investment, coupled with slow planning, means property prices will remain elevated for some time. At KD Funds, we have a strict investment process. Before an investment is approved, the asset management team engages with the borrowers and follows a proprietary and standardized risk assessment and model as part of a thorough due diligence process. If deemed a suitable project, it's approved by the asset management team and referred to the investment committee where it's assessed in a macro context. If approved by the investment committee, it's then sent to the trustee and custodian for assessment against the covenants of the fund. Funds are then advanced to the borrower, and the custodian holds each mortgage and the securities on behalf of investors in a segregated trust account. Monthly drawdowns are assessed by the borrower, the asset management team, the investment committee, and the custodian before release. Interest and principal repayments are repaid directly to the specific trust, and the custodian distributes proceeds from the segregated trust accounts. We'd like to offer you an invitation. We're looking to co-invest with qualified, sophisticated, and wholesale investors who share our passion for property in Sydney, the opportunities, our ethics, and our values towards supply-demand fundamentals. Investors become family. We must be aligned for applications to proceed. The minimum investment is $100,000 for a minimum period of 24 months, or where it's a specific project-related investment, the duration of the project. In summary, the key reasons to co-invest with KD are: there are no fees payable until investor capital has been returned. Management capital is first loss. We have a Sydney Metro focus. We know the market, the rules, and understand the risks. The team has successfully resolved some of the most challenging site and planning issues on some of the most competitive sites in Sydney. We have existing partnerships with some of Sydney's most knowledgeable and professional consultants and contractors in civil and building. We're audited annually. All investment decisions are conducted by a rigorous asset management team process with investment committee oversight. The fund and trustee are monitored by external custodian, and the market is experiencing a generational change. Non-bank lending and credit opportunities are becoming available to sophisticated investors. I'd like to thank you for your time, and I look forward to joining you in our deal room on CRIISP.
Hi everyone, my name is Jim Castanier. I'm the Managing Director and co-founder of Versailles Capital. I'm pleased to present to you the latest innovation for investing in property development. Indeed, in one of the most exciting and livable cities in the world, Sydney, Australia. Versailles Capital is a funds management company founded specifically to raise capital for investment in property development. The opportunities I'm about to show you are typically investments into large, high-density mixed-use property development projects, and based on past results, which I will share with you in this presentation, can be highly profitable and may provide outstanding returns for our investors. So significantly, the investments that VC offers occur at the front end of the development process and therefore carry much less risks, as well as a shorter investment period. Before I demonstrate this exciting opportunity, allow me to introduce the Versailles team. Collectively, the team has well over 110 years experience in property development, accountancy, financial services, etc. Please visit the Versailles website for more information on each of our members. Now, to fully understand how the investment strategy works, we need to understand the property development process itself. So this flowchart shows the major milestones in the process, and we start with sourcing the site. We do our due diligence and financial feasibility to determine viability based on very strict criteria, I might add. And if the site stacks up, we go and acquire the site, importantly, using call options. Now, using call options keeps both the acquisition costs and the risks to a minimum. We then obtain DA approval, which creates the uplift in land value. Now, if we were to build, the next steps are to sell off the plan, get bank funding, I should say, contract a builder, and go through construction. However, under the VC model, we do the front end only, which is essentially the site acquisition and planning approval process. Once we obtain the DA, we on-sell the site onto developers for significant profits. The investor gets paid their ROI at this point. And this is usually about 18 months to 2 years from site acquisition. Now, note that we do not undertake construction, as I mentioned before, so there are no construction risks, marketing risks, and there is no debt for construction. Now, to demonstrate this reduced level of risk, I will go through a case study of one of our current projects at 8 to 12 Sorrel Street, Parramatta. Now, this is a comparison of our option strategy against the traditional method of buying land. It's a cost analysis for site acquisition and obtaining DA. Now, this is a live project. It is fully funded, and DA for 300 apartments and commercial space is expected within the next 15 months. Our analysis indicates an uplift in land value from $44.5 million to $74 million when DA approval is gotten. Now, the options will then be to sell to a developer and profits distributed. Indeed, let me run through the numbers so you get a sense of how profitable the call option strategy really is. So you can see there that the purchase price of land is 44.5. The purchase price, if you're using options, that's option fees, is 1.485. Projected cost to obtain DA is 2.915, same for both scenarios. The total project cost, therefore, when using options is $4.4 million, and if buying land, $47.4 million. Now, value of land, or uplifted value of land, if you like, on obtaining DA is $74 million for each scenario. The gross return on the project in dollar terms is 25.1 million for call options and 26.5 for buying land. Now, the difference is this: the gross return percentage for options scenario is 570%, as opposed to 56% if you were to buy the land outright. Now, by using options, the risk once again is 4.4 compared to buying the land. The risk is then $47.4 million. The return can be, by the way, sometimes 10 times the traditional method. So the advantages of using the VC option strategy when compared to the standard industry practice of buying land outright are these. Now, if you were to buy land as a construction developer, you would need large capital requirements, external funding, and product of the plan pre-sales would have to be undertaken. The investment term and therefore the construction term would be somewhere around 4 to 5 years. You've got builder risk and construction risk, and of course you've got market risk in having to sell both off the plan and the finished product. If you were to look at the option strategy that Versailles espouses, you would have to, relatively speaking, only raise a small amount of funds up front. No debt is required. The wholesale market of the site makes it much easier to sell once the DA is gotten. This whole process takes 18 to 24 months, and there is no construction risk, and of course there's no market risk to on-sell the apartments. So let's have a look now at one of our completed products, or completed schemes, I should say. This is the development of 130 apartments at Epping in Sydney's northwest. Again, we followed the low-risk VC call option strategy, obtaining DA and on-selling. In this instance, we sold it through CBRE project marketing. So here's the feasibility analysis. If we were to build and sell. So there's total revenue of $97 million, as you can see there, total development cost of $74 million, and a profit of $24 million, or 32% profit margin. And here's the outcome using the VC strategy. We sold the site for $35 million, making a gross profit of $9.2 million after the seed capital was paid. The project ROI was 738%, with an internal rate of return of 492%. This is over a period of just 18 months. Note, our financials for this project have been lodged with the tax office and are available to substantiate. However, we do not guarantee future results, and of course, those can vary significantly from project to project. So as you can see, if done properly, investment in property development can be very profitable. So what stops people from investing? Well, the main barriers that we see are these: lack of opportunity to invest, well-established industry players, only club, if you like, is usually the go, limited number of quality investment opportunities. Traditional developments can take 4 to 5 years, leading to added risk, cost overruns, and vulnerable to economic shocks. Delayed return on investment, and there's a lack of knowledge about the industry, which creates fear. So VC has found the solution. We do all the upfront work to maximize uplift value, I should say, including optioning the right land at the right price, obtaining all the planning approvals to achieve highest and best use, and make the site ready to on-sell for significant profit to other developers to build. This means because we're not building, we can run multiple projects concurrently and provide opportunities for investment. Secondly, the turnaround time for investment returns are generally within 2 years. We do not purchase properties outright, so no big outlays and no debt. Our strategies do not carry construction bank funding risks, as I mentioned before, and investors are provided with full details of our investments, and we educate them about the process. So allow me now to present you with the opportunity to invest. So to date, VC has raised $5.5 million from our shares in our initial share raising in 2009 and our subsequent property ventures. We are now seeking a second capital raise of $3.2 million, which represents 14.4% of the company, to continue our property acquisition strategy and growth phase. So here's how the funds will be distributed. The 3.2 proceeds received from investor share sales will be allocated as follows. So $1.5 million towards the initial investment of site number 3, $1 million as the initial investment for site number 4, $500,000 establishing the Versailles Capital Property Fund, and $168,000 are running costs for Versailles Capital. Our milestones look like this. Over the next 12 to 18 months, we plan to achieve crucial goals that will contribute to the valuation of the company. So September 21, planning proposal approval for the current site at 8 Sorrel Street, Parramatta. December 21, VC Capital Fund, VC Property Fund, I should say, will be open for investment. March 2022, we'll attain our third project. June 2022, attain the fourth project. June 2022 as well. Complete the project at 15 Hawke Street, Huskisson. And September 2022, we will sell the site at 8 Sorrel Street, Parramatta, on receipt of the DA. The investment highlights, therefore, as a summary, we aim to attain 3 new sites every year. Our aim is to list also on the ASX. Funds under management in our property fund of $50 million within 3 years, and achieve $1 billion worth of projects under management in due course. Your next steps to success are these: make an appointment for a confidential one-on-one discussion through our Wholesale Investor platform, or contact us directly, Phil Adamsevich, on 0412519414, and Jim Gastinier on 0419 220022. Thank you for your interest in Versailles Capital. We look forward to supporting you on your investment journey. Bye for now.
Hi, I'm Philip White, founder and CEO of Zyte, the virtual inspection platform changing the way we do site visits. In a nutshell, Zyte is a software as a service platform that enables our customers to replace physical site visits with virtual ones, saving them time and money while reducing their carbon footprint. The problem we're solving is all about productivity. According to McKinsey, the productivity lag in construction alone cost the world economy $1.6 trillion in 2020 alone. This is further reflected in low operating profits and declining house affordability. Construction is far from alone, however, and many industries suffer from the inefficiencies and costs associated with physical site visits. These include the obvious travel costs as well as labour costs, the cost of time. Perhaps most significantly in many cases is the cost of delays. For example, a delayed building inspection can lead to tools down on site and quickly escalating costs. Video conferencing and messaging apps are great for business. However, data and reports show that they have not brought the same productivity gains to the area of virtual site visits, for which they were not designed. One reason for poor adoption is that they cannot be easily used with new users outside of the organisation. This can be stakeholders such as contractors, council inspectors, and customers. They require some sort of onboarding for the on-site user, such as installing an app, registering, or learning how to reverse the camera direction. More importantly, they lack crucial inspection features like the ability to get reliably clear photos, perform GPS location, and do measurements. Worst of all, perhaps, they use a lot of data, meaning that they are not useful in many situations. Finally, they often fail to align with the business processes already in place, meaning that they add work to the process. So, how does Zyte solve these problems? Well, starting from a regular phone call, Zyte allows you to see exactly what the other person is seeing. This includes crystal clear audio and photos, 3D scanning, GPS location, measurement, support for wearable cameras, and much more. And all of this while using just 10% of the data of an ordinary video chat. No app to install, no registration, no login. It just works. This is the reason why our customers in insurance, local government, health and safety, construction, and trades trust us with processes like building inspection, insurance claims, and quotes. Looking at our secret sauce, we see that it consists of 4 main components. The first is Magic Connect, our proprietary technology that enables our customers to enter inspection mode with anybody, anywhere in the world, instantly. They currently use this with China, Vietnam, the USA, UK, India, New Zealand, and Australia. The second is Low Data, another proprietary technology that allows us to use just 10% of the data of a normal video chat while still delivering crystal clear audio and photos, making Zyte suitable for use in residential and commercial construction, roadside assistance, and many more scenarios. Zyte is fit for purpose and innovative, meaning it has all the features that are needed for an inspection and many new innovations including 3D scanning and wearable technologies. Because we have been ahead of the game in these areas, we are well positioned to make use of the rapidly declining cost of LiDAR technology. Zyte is enterprise ready, meaning that we make it very easy to tick all the boxes for IT and compliance, security and privacy, deploy quickly and measure the ROI. Our competition can be divided into 3 camps, the first being video conferencing software like Zoom, the second being messaging apps like WhatsApp, and the third being inspection software like TechC. As you can see, Zyte comes standard with all the features you would expect. On top of this, we have a number of specialized inspection features which set us apart from the pack. Finally, we have a core of unique features based on protected IP which give us a clear competitive advantage. The market for virtual meetings in 2020 was worth $9.2 billion. The market for virtual site visits in construction, New Zealand, Australia and the UK that Zyte is targeting is estimated to be worth $2.4 billion. This means there's plenty of room for us to increase our revenues to our initial target of 5 million and then well beyond in the years to come. Let's turn now to a few case studies. The first is Auckland City Council, which, covering a population of over 1.6 million people, is the largest council in Australasia. They have renewed their license for a third year, used Zyte for thousands of building inspections, and now mandated the use of Zyte for certain kinds of inspections. The second is Tower. After successfully deploying Zyte for use by their auto repair network in New Zealand, Tower has now expanded the initiative out to the Pacific Islands and are looking at other use cases where they can use Zyte. We also have several exciting partnerships, including with Objective, an Australian-based provider of digital government software, Ferret Tools, which makes wearable cameras, and Safer Cities, who have integrated us into their emergency response platform. A few words about myself as founder. I was hired out of university to work for SAP at their head office in Germany. During my 10-year tenure there, I was awarded a US patent for my work in big data. Throughout my career, I have focused on big data, AI, and mobile technologies and accumulated 20 years' experience leading international teams and developing award-winning products. I am very fortunate to be joined by a great team, including Warwick Beauchamp from Parkable, Jason Glover from Pushpay, and Jenny Fernan, a property developer. So far, we have raised $150,000 of our $800,000 goal for this round. This is in exchange for 15% equity, valuing the company at $5.3 million based on our forecasted earnings, comparable peers, and IP valuation. We worked hard to refine our technology and platform to the point that we have a loyal customer base across multiple verticals and geographies. Now it's time to hit the accelerator. After completing our raise, we plan to expand our foothold in Australia by increased spend on sales and marketing, with a goal of 1 million ACMRR in Q4 of 2022, leading to a Series A raise in 2023. We plan to use the funds from the raise, Callaghan Grant, and our revenues to invest heavily in sales. We will use over half of our funds on sales and marketing, with continued research and development in order to support our position and our product. Of course, the details for this can be seen in the investor deal room. So again, we have a loyal and growing customer base with global usage, including in Australia. We have a unique and difficult to replicate product which solves a very real business problem. And we have global partnerships which are helping to extend our reach. Investors have already joined the round. Please do check out our deal room and reach out to us. We'd love to involve you.
I'm Michael Jansen, City Zenith founder and CEO. For the last 25 years, I have invented technologies that make buildings and infrastructure more efficient, more sustainable, and more profitable. Early investors in my last company multiplied their money 17 times within just a few years. And City Zenith can go much further. We recently signed $4.6 million in new contracts, and were appointed to the World Economic Forum's prestigious Global Innovators Program. So what's all the buzz about? City Zenith's 3D digital twin software platform, SmartWorld, is revolutionizing how major building and infrastructure projects are designed, built, and run. Developed by the chief architects behind Google Earth, SmartWorld makes building professionals 20% more productive, cuts 35% of operating and maintenance costs, and eliminates 50 to 100% of all carbon emissions in buildings of any size, all using one tool. Market sources say the 2020 global digital twin market was worth $3 billion and will rocket to $48 billion by 2026. And we are already recognized as an early market leader today alongside Microsoft, Siemens, and Philips. So what's driving it? A hugely inefficient built environment, costing the world hundreds of billions of dollars every year. Today, 90% of all major projects are behind schedule and over budget, and cities can be blamed for 70% of all global carbon emissions. Smart World is solving such problems, and how we do this is unique in the market. Unlike other digital twin products, it is not a service, but a true software platform that enables customers to easily create their own virtual 3D twins, integrating a vast array of data sets and AI services to solve highly complex problems common in major building projects. Real estate owners, developers, architects, city planners, and major infrastructure operators love the scalability, user-friendliness, and out-of-the-box integrations with existing tools. Indeed, this is a great time for the company and a great time for shareholders. We're now targeting a 7 to 10 times return for investors within 3 to 5 years. Or even earlier thanks to a new regulated secondary trading platform, we're on a mission to eliminate carbon in cities around the world, one building at a time. Please visit cityzenith.com and click on Invest to find out how to join our investor community and gain real shareholder value. We've recently welcomed 5,000 new investors from over 20 countries, and we welcome you to join us too.
Hi, my name is Mark Furman, and I'm an executive producer at Rezistor Films. Thank you for taking the time to review the information memorandum for our production slate. Rezistor's mission is to produce director-driven theatrical and streaming content for a global audience in two main categories: prestige dramas and elevated genre films. We celebrate commercially viable cinema and aim to create entertaining films that endure as timeless works of art. The following video will explain our financial model in more detail as it applies to the slate.
Hi everyone, I'm Tyler Nigger, Executive Producer of Rezistor Films. It's my absolute pleasure to present this opportunity to you to become a part of the burgeoning Australian film industry. As an investor into our independent production slate, you'll be privy to a unique financial model that puts our investors first. Let me explain how the industry has changed recently so that we can guarantee this low-risk, high-return model. During the 70s, 80s, and 90s, private investors would front up 90 to 100% of a film's capital, essentially bearing most of the risk. The producers, or production company, would also be paid first, with investors being paid out last. There were also only two limited ways to get the product to the consumer, both of which had a short shelf life: VHS or DVD, and cinema release. To add to this, risk management and mitigation strategies left a lot to be desired, as they were operating in a highly unregulated industry with no clear strategies to protect investors. As a result, investing in film became known as high risk. In 2008, the Australian Film Commission was abolished and replaced by Screen Australia, a modernised organisation with clear strategies to boost film production and investment in Australia, including generous rebate programs. Couple this with the advent of streamers and video on demand, and the revolution was nigh. Rezistor Films operates off a low-risk, high-return, investor-first finance model. This means our capital investors are first-ranking, and as such, are paid first. Private investment is also capped to finance a maximum of 40% of the budget, lowering the risk substantially from the days of 90 to 100%. The streaming and video-on-demand revolution, which is in full swing, also means there are now multiple sales avenues, and the sales window is sustained for much longer. One of Screen Australia's current initiatives that makes this all possible is the 40% producer offset program. This means that for our Australian productions, on receipt of what is called a provisional certificate, 40% of our budget is essentially covered by Screen Australia. We also receive minimum guarantees, which is a sort of prepayment from our sales agent or distributors that equals around 10% of the budget. Another minimum of 10% comes through reinvestment from our vendors, such as the post-production house we'll be using for post-production on our films. This leaves around only 40% to be covered by private investment, and perhaps most attractively, because of the offset and your first ranking status, the film does not need to recoup its entire budget for our investors to receive their return. Using our current model, we can conservatively project a 20% return within 18 to 24 months. That's easy to say, but let me explain how we can confidently back this assumption. Before developing our budget, we work with sales agents to receive sales estimates, or what they imagine they will be able to sell the film for. This number is based on the commercial viability of the script, the proposed lead cast, the director, and the producers. You can see an example of these estimates as they apply to one of our projects in our information memorandum. Sales agents give us a low, medium, and high estimate, with typical revenues falling in the medium category. We work back from the low-level conservative sales estimates we receive from our sales agents, factoring in a minimum 20% return for our private investors before we arrive at our film budget, or what we will spend on the film. This means that should we hit our low estimates, our investors are guaranteed a minimum 20% return. Should we hit our medium or high-level estimates, this number is much higher. Now, another issue that stifled the film industry previously was the lack of risk management strategies. We remedy this by having an independent completion bond guarantor underwrite the films. This in turn is managed by a third-party watchdog who ensures the production runs to strict regulations and absolutely 100% guarantees the film is made on time and on budget. Further, your investment will sit in an independent trust fund, which is responsible for paying you first before anyone else. I'll quickly run through our revenue waterfall scenario and distribution of funds. This is explained in more detail in our information memorandum. Out of our distribution revenue, in first position, the debt lender is repaid 100% of all loans and outstanding interest against debt-financed film assets. In second position, to first-ranking capital investors, 100% of revenue equal to 100% of their capital investment plus 20% premium for a total of 120%. In third position, to second-ranking capital investors, 100% of revenue equal to 100% of their capital investment. In fourth position, the remaining amount of revenue after deduction of the above costs and expenses is generally referred to as net profits, to be distributed in the following order. 50% to capital investors, pro rata and pari passu, up to 30% allocated at its discretion by Rezistor Films to pay any profit share to which any cast, director, writer, producer, or other film personnel are entitled, and thereafter, any remaining balance to Rezistor Films, which collectively represents the producers of the feature for its own use and benefit. Having a successful film on your hands can be incredibly rewarding, and we will have tiered producer credits from associate producer up to executive producer, depending on the level of your contribution. For our accredited producers, you will be invited to join us on the set of the films and on our festival run, and will be deeply involved in the sales process. Our production slate is ready to go, with incredible scripts, world-class production teams, and sales and distribution partners. Please do view our detailed deck and don't hesitate to reach out with any further questions. We look forward to discussing this exciting venture with you further. Thanks a lot.
Hi, and welcome to Venture Capital Day 2. Today, we're about to kick off our keynote interview with the managing partner of FAT Projects, Mr. David Andrade. Welcome, David.
Hi, Steve. How are you? Thanks for having me here.
Mate, very well, thank you. Now, obviously, this is a very exciting time for you, and I think it's a unique opportunity for us as well to have you as part of Venture and Capital in that You know, when you first mentioned to me that you were going to be doing your own SPAC, straight away I had in mind of hosting a session like this, because I think from as an Australian's perspective, we've heard a lot about SPACs over the last sort of, let's call it sort of 12 to 24 months. And we don't really have that much information sort of on it. So what I'd love to do is I'd first love to do a bit of a deep dive into you guys, Fat Projects, as a first step, and a bit of a background about yourself. So if we can kick off the session, can you give a bit of a background about you?
Sure, happy to. So training is in banking, finance. I was a global banker for 20 years, which took my career really from Sydney to Singapore and US, and literally having, I was joking to another mate the other day, and I said, "Oh, my kids were born in a different city," right? So it's been that time, and it's spent about 7+ years overseas. And my last role was actually with HSBC Bank, where I was a global sector head running the natural resources team out of Houston, Texas. So that's on the personal side. On Fat Project, so we're an investment and venture studio, which was established in 2015. It's a company that I co-own with another Aussie based in Singapore, Tristan Lowe. So essentially, look, we've got two parts of the business. One is, as a venture studio, we've got a portfolio of companies.
So just quickly, just to explain to everyone, what actually is a venture studio?
Yeah, okay, I'd love to explain that a bit more. So it's really, a venture studio is really like an in-house machinery that then spawns startups, right? So we have our own effectively stable of companies that what we do is we spawn them ourselves. We provide founding capital. We provide the initial C-suite coming in, right? So potentially myself going in as co-founder, CEO, or Tristan going in, or one of the partners going in as CFO or growth officer. We then get them to a point where they're effectively post-revenue, right? So you put in the founding capital, you've built the tech, you've got the infrastructure in place. We then kind of bring in the institutional monies in. That's when we kind of go in and bring in VCs, and then essentially hire your founding team, who will then help them scale. So we've done that, quite well over the last few years. So that's one part of the business, and to be honest, that's really the fun part of it, right? Because that's when you really roll up your sleeves and get busy in your own startups, right?
Because I imagine when you meet these founders, they're effectively pitching you as a seed idea. Is that correct?
That's correct. And essentially, what we've been doing is, some of the conversations we're having is, they go and pitch us and say, "Hey, we've got a really cool idea, but we've got a really cool business concept, but we actually don't know how to do it," right? We've never raised capital. We've never built our own tech, but we kind of know what we need to do, right? We've never scaled multiple jurisdictions, and, come in, and we also need some money, right? So we go in and essentially partner with them to do that. So that's one part of the business. The other one is more of our public markets facing business. And that's really where the SPAC is housed, right? So that's where we have our own kind of SPAC business, or ventures, if you like. And then the second part of that is really taking our investments public.
Gotcha. Now, sorry, I was going to go back to the venture studio part. So I imagine that founders are excited to work with you for the fact that, both yourself and your partner have that experience in taking companies from the early stages. And then do you obviously provide them with international connections to help in accelerating that growth? Is that typically the model that you use?
Yeah, absolutely. And I think one of the things that, we know as founders as well is there is this, what you call founder fatigue, right? You kind of have a great idea, and no one really thinks about the exit, right? So they're going and saying, "Well, I've got a great concept. I think this will solve a legitimate problem. I need some money. Sure, I raise a capital, but what's next, right?" And what happens after Series A, Series B, Series C, right? So what we're trying to do is then, how do we accelerate that conversation from an idea, not so much an idea, it's too early stage, right? But kind of Series B level, and say, okay, well, in the 12 months time, why don't we have a path to IPO, right? And that's really what founders want to do, right? Ultimately, they want to take this company public, right? They want to get that material valuation gain and essentially cash out at some point, right? And that's really what we're trying to do. How do you then kind of bridge that quickly? And in our view is our expertise is really US capital markets.
Got you. So in your mind, the way you work with companies is typically they come to you with that seed idea, you provide some initial capital, help them get that sort of product, at least develop that sort of MVP, then work towards that sort of product market fit, then sort of growth, scaling, et cetera. At the same time, supporting companies as they go through their growth journey with that capital. And then now, obviously we're going to be talking about the SPAC in a second, understanding that founders are looking for an exit at some point, whether that be via an M&A process or via a sort of exit via an IPO. You want to assist in that pathway.
Yeah, absolutely. And also it's really co-creating as well, right? So sometimes you've got founders that we deal with and part of our network that have an idea, and you really test it and say, well, actually, what's the total addressable wallet of this product, right? Is this is this a marketable solution, and which geographic fit does it fit, right? So a lot of that is really part of the conversation you're having with co-founders working with us along the way.
Brilliant. Now, obviously, we're going to sort of talk about and I see you got the great logo behind you, the Fat Projects Acquisition Corp. So obviously, this sounds like it was sort of created in a desire to solve one of your own challenges or a challenge that you're seeing for founders in that the sort of creation of a pathway for exit. So just give us some initial ideas of how this come about, how long it's sort of taken to get to this stage. It'd be great as far as for an insight for investors, the real length of process that this takes.
Sure. Look, we've done a lot of research in this, Steve, and internally, right? And we really looked at this in two lenses. One is from a founder lens or a company lens, and then the other one is an investor lens. So, I've alluded to you earlier to, and the first question is around on the founder side. There is absolutely a worry sometimes, right? Where you kind of get deep in, and we've seen this many times, where you go founder, raising the capital, building products, raising capital again, building products. And you guys are obviously helping on that front and Wholesale Investor, but not really understanding what does it actually mean? What is the exit path, right? So we've always seen that it's almost like a big black hole, right?
And in fairness to some of the founders, though, you sort of get conflicting. Like as a founder, you get conflicting messages. Some founders, some VCs or venture investors get upset when the founders are talking about potential exits. Other investors are asking the question about when are you going to exit. So you're sort of in this sort of you sort of got two different forces pulling at you when you're having discussions with investors. So it is a bit of a confusing area.
It is, and the reality is, if you peel the onion and you speak to every founder, they're not doing this for a charity at the end of the day, right? So of course there's a mission, vision, but at some point they want that kind of hard work, blood, sweat, and tears translating into real monetary value, right? So it's like, okay, so we know that that's a real problem, right? Messaging is one thing. The other piece is on the investor side, right? So if you look at investor, where do you really get the most alpha, right? So, we look at comparables, and really, if you take on US company or non-US company, particularly in the US, and the arbitrage is significant. I mean, we're seeing companies that in Asia Pacific, for example, right, EV revenue might be, call it 1 to 2 times, and they're happy with that, right? And in private markets, it's even less. And then we take them in the US, and it's like 5-10 times more, right? So you absolutely see there's a massive arbitrage for an investor. So if you're an investor standpoint, how can you get in a company pre-unicorn? Right? How do you get to a company before they become the next household name? So the idea there is really, okay, let's work on, I would call it the fringes, right? So if you look at our team, and particularly in our SPAC, our expertise are predominantly in Asia Pacific, Southeast Asia, and also Europe, right? So we're thinking about, okay, so how do we then look at the companies, the founders that we know, give them a path to exit, give them a path to an access to real capital, right? And then actually bring our investors along the way to again help them pick up the alpha along with us, right? So why would I go and invest in, potentially a crowded marketplace in the States and looking for US companies when there are actually tremendous amount of non-US domiciled companies that are out there?
And what I find interesting about your approach, and you're spot on in what you said in that sort of value arbitrage. Like I see that with Australia, you know, especially like the two areas in the more sort of technical areas like sort of life science and also in renewable energy sort of technology, there's a massive value arbitrage between what you see as values companies get in Australia versus what you see they can get in Europe and also in the US as well. For you, how did you form your, like obviously, you know, so you got a banking background. I imagine you and your partner spent a lot of time thinking about, okay, what is your investment thesis? And in that you would have observed a lot from what's actually happening in ASEAN and also in Australia as well. How did you come to what is your investment thesis and how did you come to it?
Yeah, so it's going to be, so the investment thesis is really technology and Southeast Asia, right? So if you look at, let me cover off the region first, right? So if you look at Southeast Asia as a region, you know, you've got a digital native cohort, right? Young population, 600 million kind of workforce, if you like. And to give you some context, right? And again, this is quite interesting. So if you look at, there was a study by Bain and Google, and between 2019 and 2020, there were 40 million new internet users online in Southeast Asia, right? So if you think about 40 million, that's almost double the size of the Australian population, right? Literally going online and now consuming, right? So if you look at that it's almost like a new frontier, right? So you've got a population that literally skipped, from no internet, no laptops, right? Nothing like that. Literally got a mobile, right, and started consuming. So if you have that captive demographics, it's actually quite interesting to operate. And there's a lot of good companies really serving that space, right? And you also
you could also add to that what's been very common in the transfer of wealth, which everyone's sort of talking about over the next 5 to 10 years, from baby boomers to sort of millennials and Gen Z. Yeah, absolutely. And there is this, and again ties into the liquidity as well, right? If you think about kind of more on the liquidity space, you have over the last couple of years, or at least over the last 18 months or 2 years, there's been high growth of, high liquidity, low interest rates, high savings, right? Government stimulus, digital transformation, creating new industries happening every minute, right? You've got a captive and network effect that goes along with those digital adoption as well. So the speed at which things are innovating is incredible.
And you have a captive audience that over the last 12 months were on lockdown looking for investments, right? Literally, right? So you've got this, merging of like, okay, good technologies being built, a captive audience, high liquidity. I mean, you see that in all asset classes, right? I mean, that's why the property market is booming as well in most capital cities. And then you have this massive bull run, right? So looking at, okay, how do we then kind of capitalize on that? So we looked at the team. And what we made sure is we wanted to make sure that we have a varied skill set that actually have experience in the region. So you've got, if you look at our team, we've got mostly, I think 92% of the team members have got experience in Southeast Asia, either live there or have lived there. Some of the profiles, and again, this is all public markets information, right? And it's all public. Some of the profiles we have there is, for example, we have, ex-group treasurer of Rio Tinto sitting in our board as a non-exec. We have, a chief data officer at JP Morgan, group-wide, sitting on our cap table, and also in our board. We have, execs from Salesforce, execs from, various kind of largest multinationals out there that understand scale, understand the region, understand, how to take the nuance of an Asian company or an ASEAN company or an Asia Pacific company into the US public markets, right? Translating that, because the reality is, if you go to the States and typical, if you say I'm doing a Asia, investment thesis, people would always think it's China, right? So, but actually people have forgotten that there is a big part of that is Australia, where there's building a lot of good tech, right? And then you've got a big cohort in Southeast Asia, which is really growing as well. So we had to make sure that the team is there, the team is right, we've got the right, skill set there to work with us.
And in the I suppose acquisition targets that you're going to be looking for the SPAC, is there any sort of key factors that you're looking for apart from sort of obviously being Asian focused? Is there certain sectors that specifically that you're looking at, like in that sort of technology? Is there other niches that you're sort of more interested in, or is it more sort of B2C type businesses attracting, you know, X% growth per year that you're sort of targeting?
Look, from our perspective, it's obviously technology, and the subsectors is quite broad. So we're open to look at, you know, it could be payments, it could be e-com, it could be food tech, it could be, you know, agri-tech. I mean, we're okay with that as long as the enabler is technology, because we know that that is what will scale the business, and that's where you can transfer the technology, you know, outside of Southeast Asia and even global domination, right? So that's that. I mean, we look at obviously sound fundamentals, making sure that they've got proven economics. So this has to be a company post-revenue where we can actually define that, okay, if we have $100 million of capital in there injected into business and further access to US capital markets, what will that, you know, how will that get you to, you know, a certain level? So we want to be able to define that measurable metrics. We want to look at competition, right? So, you know, are they top 5 in the segment they're operating? We always like to see competition, right? So if they're operating, what we don't like is a company saying to us, this is a unique product, no one else does it, right? And, you know, I've invented it and I'm the best. Like, we want to be able to actually test the application and that market fit. Management is important, right? So, you know, we've seen a lot of founders, and we know a lot of founders who are really good technical founders, right? And really know what to build. But actually articulating that to a US audience is actually sometimes a massive gap, right? And that's right. That goes back to the prior question that you asked. Is, you know, we wanted to make sure that we have a team that can kind of supplement the founders and, you know, help them finesse the message, help them articulate their message. Because as I said earlier, sometimes it's an understanding of the market nuance, right? So how do you then translate Asia problem into US story? Scale, absolutely, we've got to look at, right? You know, is this applicable to Southeast Asia only, right? Or is this a global potential solution? And how big's the market, stage of the business? There's a lot of these things that we would look at as part of our due diligence.
Fantastic. And, you know, for me, as I'm sort of listening to this, you know, when I first started hearing about SPACs, and like similar to you, like we're friends with the guys at Vickers. We know they've also done a SPAC as well. And I also had other sort of Asian sort of VC friends that were sort of mentioning about this. Now, in Australia, the ASX hasn't been the biggest fan of sort of, they call them sort of, you know, public sort of cash boxes. But what I think's interesting is that the SPACs are providing a different source of growth funding for the founders along with the exit. So what I'm curious to ask now is, from the other side, is that how have you found the experience in, I suppose, because how have you expound the conversations with founders from their perspective, their willingness to go through this process and their enthusiasm for the process? I'm keen to understand that, because I imagine it's substantially different than if you're just chatting with them about a sort of normal venture style investment, because it's got two factors in there. One is that potential for valuation arbitrage that you sort of talked about, but then the other aspect in that their shares will be traded on a listed exchange and therefore setting a value for their own sort of personal holdings.
Yeah, I mean, obviously we haven't identified a target as yet, but again, based on conversations of founders we know, it is a prestigious exchange, right? So for someone, you know, a typical, I mean, if you look at an Australian company, a typical kind of path to an IPO is they'll go, okay, let's raise capital, let's go to ASX, maybe dual list, right? And at some point, maybe go to NASDAQ, but it's really it's almost a near impossible kind of jump, right? Sometimes.
Well, you wouldn't know where to start, right? That's the reality. You don't know who to make that first call with to get that introduction to, whether it be a brokering house, corporate finance group, to have a conversation. But then you start hearing about deals like Grab, for example, sort of looking to do their SPAC, and then also there's been plenty of other examples. You start thinking, okay, what if this is an option? Like you put a face to a potential pathway as an option that most founders would think, that's not possible for me, which is always exciting for founders.
Exactly. So it's almost like it's too good to be true type of thing. It's like, okay, so you're saying we can get to the US and you've already got a SPAC or a special purpose company or a blank check ready to reverse into, right? And then you've also got a team that can augment the team composition that we have and people that have got experience in working in public markets, public companies. So it's like, that's almost like, and that's really what the SPAC is, right? It brings in capital, brings in people together, and then trying to spot a company to then kind of, buy them and, merge with them in a good discount and trade them at the US exchange. So that's really what we're seeing. And look, from a market standpoint, what's exciting, I know you mentioned the ASX, and ASX have kind of, I haven't seen any new guidance in the ASX in this, but what we're seeing is, the SGX, I think the last couple of days, Bloomberg came out with an article whereby SGX, the Singapore Exchange, is actually looking at allowing SPACs to basically go into Singapore.
And to be blunt, I'm not surprised, given how many, I said, ASEAN VC friends or investment groups similar to you that I've spoken to that are looking at SPACs as an option for some of their investee companies.
Yeah, absolutely. I mean, look at you mentioned Grab earlier, right? And they're a Singapore homegrown and now listing in NASDAQ, right? For right or for wrong, right? The NASDAQ is winning, right? Or the US capital markets are winning, right? Because they've now suddenly got arguably the next Amazon, right? Or the next super app out there, right? And in a highly captive audience. So it's quite an interesting place. So obviously Singapore's gone in there. I know Hong Kong exchange are looking at it, even Indonesian exchange is looking at it. I don't know what the Australian Stock Exchange will be doing on this front, but that's on the exchange side, and that really validates the concept, right? People have always bashed. I mean, SPACs have been out there for a long time. Oil and gas used to do this, right? You've got a blank check, kind of concept, decades, right? But because of the massive growth in the in the SPAC and the new SPACs coming out, there's obviously a lot of these questions. Is this the end of the boom? I mean, we're not investing in this to obviously, to think that we're not, still going to pick up the upside. But the reality is the fact that other exchanges are looking at it, that's actually a validation. And then you've also got like big, private equity and fund houses like, last week, I think Apollo Asset Management launched they've got an AUM of 400 billion, right? To give you a context of the size. And they're launching a SPAC specific fund, right? This was last week, August, end of August. So if you think about that investor base, there's still massive opportunity there that are available, in the SPAC space.
So, and moving to that, right? So first we've discovered a bit about you. We've sort of talked about, the sort of path to sort of creating a SPAC on your side, and then why it's of appeal to the last part, I think, is also what I want to understand sort of personally, and hopefully the audience does as well, that's sort of participating in venture and capital. That from the investor side, why has this been such there's been so much capital raised via SPACs? Why is this such an appealing vehicle for investors?
And look, for investors, it's really on spotting the diamond in the rough, if you like, right? It's like, how do you then spot, to my earlier comment, a company pre-IPO, right, before they become a unicorn, before they become a decacorn? And you could, and that's really what it is, right? It's like picking up the alpha, right? It's how do you then pick up that massive delta and spotting that before it gets too crowded and before they become listed, right? And that's really what it is. So it's finding the yield, and because of the high liquidity volume out there, that's where it is, right? So you're placing it on these companies and ultimately looking for founders, who have access, or a team, a SPAC team that has access to founders that are able then to find these really top high quality companies and then taking them into the US public markets. It's really that, right? So it's highly attractive from an investment standpoint.
And is there any, in sort of doing your research of this process, is there been any sort of key success factors in certain SPACs that have done incredibly well versus the ones that have struggled once they've been listed?
Yeah, look, it really boils down to the team. The team and their commitment pre and post the SPAC, right? So how much value would these executives, and that's why we kind of made sure that we form a really solid board along with us, right? Because we want to be able to say, okay, well, you need someone, whether a CFO, for example, can someone in our bench come in and be a CFO for a public company? Tick, right? Do you need someone who's a CTO background, right? And we have someone who's as corporate CTO of JP Morgan Asia. Tina Wire was another Aussie. She was that before, right? Before she actually retired. So, all these kind of skill sets, how do we then help them post these back and get them to a point where, their share price goes up and all these things.
So I suppose it's really is, I suppose, that listed venture capital vehicle where, there is that possibility for liquidity, which obviously many Australian companies have listed on the ASX very early, and it became known as a destination for listed venture capital. For me, I just see this when you sort of explain it like that. It's just a different mechanism of doing that. But obviously, there's just a cash box set up in the meantime to make that acquisition. Now, as a final question for our session. So for you with Fat Projects, you're obviously an ambitious guy. You've done a lot sort of in your career, both as said from the banking background now into the sort of venture studio and then on the sort of corporate side as well. What's the ambitions for Fat Projects?
Yeah, look, we're going to keep doing what we're doing. On the venture studio, we're going to, the idea or the vision is to be spawning 2 startups every year, right? So 2 ideas, getting them to a stage where they're post revenue. So that's the fun box, if you like, right? Where we get really excited in building new companies. We've got a food tech coming up. That's another space that we're super excited about. It's going to be a 6.3.
I might actually have a post this. I've actually got a referral for you. I thought about it during the actual session, and unfortunately, anyone's watching this. Unfortunately, this is my brain. I naturally matchmake. It is ridiculous.
Yeah. So we like food tech, and you and I have spoken about this, right? We've done a lot of research, and it's going to be a $6.3 trillion economy over the next 3 years, right? CAGR of 194%, and we've done, and that's on the back of like a lot of the food science coming out and innovation in the food space. So we like that. So we're going to keep doing that on the startup side, and then on the public markets facing side, we're going to keep rolling out SPACs into the foreseeable future. We've lined up, as I said, the fringes, right? So we've got Southeast Asia. We're looking at another Southeast Asia SPAC and actually a European SPAC as well, just because that's where the skill set of the team is. If you look at Fat Projects Acquisition Corp.
Fantastic. Well, David, really appreciate your time, and I appreciate you giving us the opportunity to have a chat with you and go through the mechanics and the process and the sort of opportunities that you're looking for. And as I said to you, like for me, it's exciting because it's very hard to put a face on what does this potential pathway look like for an Australian company that's looking to go through, that's open to the idea of listing on a sort of, on a prestigious exchange like the NASDAQ, etc. So, mate, again, appreciate your time, and thanks for being a part of Venturing Capital.
Cheers. Thanks, Dave. Appreciate it.
The venture capital market is notorious for its illiquidity. Unlike that of public markets, investors don't have that power to buy and sell with speed and transparency. As an investor with existing equity in a company, this means 1, it's harder to restructure and rebalance your portfolio as you would in public markets, and 2, it's near impossible to liquidate equity ahead of the business's intended exit. Essentially, your cash is stuck in stocks. On the other side of the coin, there are investors who are looking to enter later stage opportunities. However, those opportunities have already closed their doors to funding rounds, and if they do reopen, they're usually reserved for venture capital firms, existing investors, or private equity firms. This means there is a high and expensive barrier to entry. So, with both these problems in mind, we have worked to launch the WY Capital's secondaries platform, utilizing our network of 30,000 plus high net worth and sophisticated investors and combining that with the CRIISP software, an underlying technology that helps streamline and facilitate these transactions. And it's already working. We are open for business, and our clients are well underway in establishing their own secondaries markets. So, if you're looking for options to sell existing equity in a company, or you want to see our most recent catalog of secondary investment opportunities, Feel free to contact us via the email on screen or reach out to us via the Brella booth for the remainder of the VNC conference.
Hi, I'm Dustin Wasnich, and I'm going to tell you how collaborative video is going to fundamentally change the world of video production for business. We are a platform that makes it easy for teams, large or small, to collect and combine video at massive scale. And when I say we, I'm backed up by an awesome team. So my history is that I started work 20 years ago with a digital television startup. I then invented the term video blog, and I've been involved in video ever since. Jeremy, our CTO, is obsessed with products, features that are only asked for by customers, customer-led product development. Taryn Myberg, our head of video, ex-Channel 7 video producer, and she's our customer success manager. And then David Taylor-Smith, our growth marketing manager, he's already propelled 6 startups to that magic $10,000 MRR mark. So look, essentially the problem that we're solving is that in 10 years' time, we're going to need 500 times the amount of video as we do currently. Now, in the consumer space, this is the challenge of how do you get every Facebook group to have its own TV channel? But in the business sense, how do you replace every document with a bit of video? Imagine if you were trying to do an Instagram story with your team, you just couldn't do it. No tools exist currently to collaborate on video within business teams. Instead, because they don't have the option of social media, it's really a 10-stage process, which means that video collaboration in businesses is complex, costly, and slow. So we've turned that around. We make it very easy for anybody to collect, catalog, and combine video clips. So we have a browser-based video uploader tool that allows anybody, anywhere to upload video in any format. And then we combine that with a complex content management and production platform all in one that allows teams to sort, to favorite, to tag clips, and then to instantly make beautiful compilation videos from those. But we're going further than that. Our goal is to automate that last step. And how we can do that is by 2 ways. One is by applying all of the corporate identity through rules at the beginning, so that every single video produced by an organization looks identical. And then the other thing is that we're using data contained within the actual video clips themselves to automatically sequence those videos. We think that we're 1,000 times quicker already than traditional video production and 100 times cheaper. But our goal is to get even quicker and even cheaper. So how people are using this, so we have customers already, some big names, but essentially they're using us for one of 3 ways. Either, as you can see with Jax, for customer advocacy, or for internal communications, as you can see in the middle of the New South Wales Education Department, or for community engagement. You see a great project that's just finished by Hamilton the Musical down in Victoria. So really our business model is fairly transparent. It's a B2B SaaS model with a freemium intro and then tiers up as we move them up the value chain. So look, our challenge at the moment, which is why we're raising some money, is to move people up those value inflection points more, and also to really go beyond that 399 model and get multiple location, multiple seats, those enterprise level plans. So who do we have as competitors? Well, not Zoom. People often say to us, aren't you just like Zoom? We're nothing like Zoom, because Zoom is video conferencing. We are asynchronous video production. What that means is that people can record video clips at their leisure and then combine them together. We do also do video templating as part of that. So people often say, aren't you just like Canva? And we say, no, we do video templating, but we're nothing like them. They don't allow many people to collaborate. So really, we're left with people like Frame.io, Video Ask, Video Appeal, and Zenith, but they don't do the 2 other things that we do of making it look good and applying rules to it to automatically sequence it. So to give you an idea of that automatic sequencing, we can sequence as these examples show, either by date, by time, by location, by stage, or even automation and integration into a e-commerce database as shown on the top right. So really, if we looked at the market potential, if we were to replace every single bit of business documentation with video messaging, we're looking at a total addressable market of about $50 billion. And this market is growing 12% year on year. But actually, we think a more realistic target in the short term is $3 billion total addressable market, which is capturing about 6% of that B2B video collaboration. So who are we targeting first? Well, we know through trial and error that actually combinations or compilations of people talking about an issue that they're passionate about is the easiest sell for us, lowest cost per acquisition. So that community engagement piece is who we're targeting first, charities and advocacy organizations. And then internal communications. This is a massive market for us. We have companies using us for video resumes, video CVs, and sales messages. And then that customer advocacy piece that we sort of started with in October last year. We actually have a network effect. We need customers to bring contributors to produce content that is seen by other customers. So this raise is about how do we spin our flywheel that little bit faster. So it's front loaded with customer acquisition, $660,000 in marketing, $450,000 to really perfect some of that technology around the automatic sequencing, and then $250,000 to make it look great. So this will give us a 12-month runway. And how that looks in figures is basically that we predict break even by about May next year and profit from June next year. This is based on revenue targets of about 225,000 by next year. But if we put more money in, we'll get more money out. So really, in summary, why you would invest in us is really if you want to be the first mover in a new sector. So we've been called sometimes TikTok for business, but it is really that new emerging market of video collaboration in business. We have ultra scalable automation. We normally do this kind of demo live and get people in the audience to all upload clips simultaneously and then display it on stage. Very, very low cost of operation. The global TAM is $50 billion as suggested, and we have an amazing team and very, very stable tech. So contact me at jw@vloggi.com to arrange a further meeting, or go on the CRIISP platform, go into our deal room, or contact us any other way, and we'd love to give you a live demo and to really talk to you about the opportunity.
Buildz.pro is the home for automotive enthusiasts and hobbyist builders. It's a free, interactive platform connecting you with the community. Get the info you need, follow the experts, and document your epic journey. Keep building awesome with Buildz.pro.
Hey guys, Mike here from the Buildz.pro team. I'm the founder of Buildz.pro, and today I'll be talking about our pitch deck along with our vision for the business and the future. Now, the problem we're addressing is it can be challenging and frustrating trying to find reliable information when building enthusiast projects to make the decisions required. And common questions get asked like, has anyone done this before? What issues did you run into? How much did it cost? And where can I find the products that were used in the solution? Now, a market opportunity exists for a digital matchmaker specifically built for enthusiast projects with the goal of helping people that build projects build them in the most cost-effective and time-effective way possible, as well as connecting people to a community of like-minded individuals. Now, the initial addressable market for Buildz.pro, we're focused on the automotive enthusiast industry, and the US market alone represents a $45 billion market and also includes possible expansion into other enthusiast markets. The Buildz.pro product consists of a social content platform, including both web and mobile apps, and a range of NFC smart tags, which enhance the sharing experience in real life for enthusiasts, as well as gamification for the product. Now, we see a critical market opportunity with the COVID-19 pandemic, where the platform actually allows individuals, groups, and businesses to host virtual enthusiast meets anywhere in the world. We already have early market traction in Australia with a range of promotions and sales where the business is already generating revenue through the sale of smart tags, branded merchandise, as well as digital subscriptions for our user base. The leadership team consists of myself as a business lead with a strong industry background in project management and asset management, and that's in both construction and manufacturing industries. That complements my existing qualifications of an MBA as well as an electrical engineering degree. My technical co-founder is Des Little. Des is a computer engineer with over a decade experience in developing software applications for the resources sector. And we're both enthusiasts in our spare time. That's actually one of my builds over there. And we've got a further 3 people working full-time in our technical and marketing teams. And that pretty much rounds out the existing team for Buildz.pro. Finally, the goal of our cap raising round here is to expand our teams, our total teams for the business. For the technical side, we'll be focusing on our mobile app experience and increasing our production. For the marketing side, it'll be powering and tuning our growth engine, pretty much to work towards product market fit and really find that repeatable and scalable business model ready for the next stage. Thanks for your time, guys. I'm Mike Laverick, founder of Buildz.pro. You can find our deal room on CRIISP, which is hosted by Wholesale Investor. And I'll see you guys there.
Hi, I'm Jamie Engel, the founder and CEO of Neutopia. So at Neutopia, we're focused on innovation in how lifelong alumni engagement happens. We do that with a SaaS platform that amplifies modern alumni engagement by personalizing content, building communities, and providing future learning opportunities. So I'll start with a story. So here's Sia. She graduated in 2016 in engineering. But then as an alumni, she decides she wants to be an entrepreneur. Her interests start evolving over the next few years. She gets interested in taking a micro-credential course in robotics, starts building a team and looks at collaboration, then takes a short course in leadership. And then as her company grows, she takes a micro-credential in finance and explores global markets for expansion. Now, the problem is where she went to school has no idea that these are her evolving interests. And that's the area that we focus on at Neutopia, the problem of the unrealized lifetime value of learners. Typically, the learning provider spends a lot of money on recruiting students, and then they're enrolled. But as alumni, they drop out of the funnel. They don't usually have much connection to their alma mater. And when they're looking for future learning opportunities, they go to other competitors. That could be big tech companies like LinkedIn Learning or MOOCs or other learning providers. And so there's a lot of lost revenue. Some of the other problems, if we go a little deeper, is because the learning provider is not able to collect any real-time data on their alumni, they're not able to send relevant communications to them. And there's a great diversity of what people are interested in. This leads to attrition, and in the end, less revenue coming in, and that leads to financial stress. So the solution that Neutopia provides is a platform so that learning providers can stay connected with their alumni and understand their interests as they're evolving, therefore promoting future learning opportunities and bring them back to their school. All of that leads to increased revenue in a world of lifelong learning. How our platform works is that we collect the data where the alumni indicate their interests. This data leads to the ability to personalize the content. So every alumni has a different experience of the platform, similar to Amazon or Spotify or Netflix, where everyone's experience is slightly different depending on their interests. Also, the ability to be involved in social groups, peer-to-peer learning, and this leads to strong social connection. And also the promotion of on-demand learning and recommendations of future learning opportunities. When we look at the competitive market, we explored how there's really two buckets. There's learning platforms and there's community platforms. Now, the community platforms in the market, some of our competitors don't focus on lifelong learning at all. They mainly just focus on things like philanthropy, giving back, and the social aspects. There's a little bit of personalization, but there's not a lot of personal growth. The learning platforms do provide high personal growth because they're focused on learning, but most of the competitors don't have a personalized experience and also don't provide social connection. And they're really not built for alumni. So that's where we position Neutopia, right at the intersection, this gap in the market where learning meets community. Now, the market is growing rapidly for EdTech, and there's one interesting statistic I thought would be good to point out is by 2035, there's expected to be 2.7 billion students worldwide. All of those people are going to become alumni. And to put that in another terms, we would need to build 2 universities per day over the next 20 years to meet that demand. So we're in a very quickly growing market. So we've set some goals of 1,800 clients in the next 5 years, and that would give us revenue of 79 million. We think that's actually conservative and achievable because a few of our competitors have achieved similar numbers in a similar 5-year timeframe. We've got some great clients and partners currently. We've experienced 100% growth over this past year. And we're tracking to double that again by the end of 2021. We also have some very strong partner institutions like Western Sydney University and La Trobe University that we're currently in programs with and exploring some pilots with. Over the past couple of years, we have had angel investment of 215,000 and some great early contracts and paid pilots. Looking forward, right now, we're looking at seed investment that will allow us to expand sales and marketing campaigns over the next 12 months, and also driving a lot of product development to meet client demand. And over the coming year, we've started some market feasibility studies in various regions, so we'll be looking at how we can enter some other regions, including India. We're looking at Canada, we're looking at Singapore, and also Indonesia. We have a very, very strong team. Multiple people on the team have deep expertise and backgrounds in education. I've got about 10 years in education and also technology. Mark Solis on the team has over 20 years, has been an executive at a university in Canada, and also has deep domain expertise in alumni engagement. He consults on the strategies for many major universities globally. Stephen Rudder has set up entrepreneurship education centers at 3 major Australian universities. And Sarah has over 15 years with digital products, building and iterating SaaS products for both B2B and B2C. And Jen Wilson has co-founded a technology company and also exited one that was based both here in Sydney and also in the UK and is still running. We also have a strong advisory team, including Irfan Malik, who's helping us with a go-to-market strategy looking at India, and Andrew Pattison, who has been CEO of a major global SaaS platform that IPO'd at over 700 million. Our ask is we're currently raising a round of 1.5 million Australian on a pre-money valuation of 4.5, and most of that money is to drive technology R&D and increasing the velocity of our product development, expanding our sales and marketing team, and also bringing on a few other key roles on the team. So to sum up our investment highlights, we have a product that's in market. It's fully developed product with recurring customers, a very strong sales pipeline, an expert team, and also the design of the platform, because it's got an inbuilt social network, amplifies network effects and lifetime value and creates a strong economic moat where once people are on the platform and those networks develop, it reduces any desire to move that community onto a different platform. So if what we're doing at Neutopia excites you, we'd love to have a chat. And just click on the QR code to check out our deal room and also get connected with us. Thanks very much.
Hi, my name is Martin Roots and I'm the chairman and founder of the Expede Group, and I'm talking to you today about Yada Campus, our answer to righting the wrongs that currently exist right across large educational institutions globally. The shocking statistic that one student commits suicide every 4 days highlights the student well-being and mental health crisis facing UK and international universities alike. This is not just a well-being issue, although of course this is important. There's also a financial imperative to fixing this problem. For the UK alone, if a single student drops out of university in their first year, it costs the university £28,000. This means a 6.3% dropout rate costs the average university £9 million per year. Yada Campus is a platform consisting of a student mobile app and a back-end analytics and reporting engine presented via a SaaS model. It aggregates disparate student journey touchpoint data, intelligently profiles disengagement behavior, and automatically intervenes with behavioral nudges in real time. Students use the app to check into class and access their core services and social events, whilst academic, admin, and student support staff use the platform for collaboration, messaging, polling, and data analytics. Yada Campus brings together data aggregation, proprietary algorithms, artificial intelligence, and machine learning to address the problem, allowing real-time analysis of an individual student, providing a comparative measure against their peers, and flagging areas where intervention may be required. The platform also allows the student to see their own progress and helps them proactively to understand where they may need assistance and signpost suggestions of where they can find support. We estimate we can reduce an average university student dropout rate by 10 to 20%, saving them £1 to £2 million a year. Most of the competitors listed here, along with their current market share in the UK, concentrate on a particular area, usually within attendance, academic submissions, or monitoring of a university system's access. Yada Campus is unique in that it encompasses all of these areas and additionally includes social event attendance, the students' utilisation of support services where they've asked for assistance, and the monitoring and analysis of a student's sentiment by directly engaging with the student via the integrated closed messaging platform incorporated within the Yada student mobile app. According to Grandview Research, the global edtech market is predicted to grow year on year by nearly 20%. And according to Hole and IQ, growth post-COVID is expected to improve on pre-COVID estimations. But estimating the addressable or serviceable markets top-down could only be based on assumptions and would therefore potentially be inaccurate. So let's look from the bottom up. The current market in the UK is serviced by a few companies, and their service offerings are roughly broken down into 4 key areas, as we've seen previously. These are student engagement, where 53% of UK universities surveyed said they had some sort of monitoring capability deployed. Our market research indicates that they are probably paying around £10 per year per student for that service. 71% have an attendance monitoring solution in place, 46% have learning analytics, 61% have a dedicated student app. Universities that have all of these capabilities are probably paying in the region of £20 per student per year. Yada Campus will provide all of this capability and more with regards to automation, workflow, etc., But to capture market share, we would charge only £10 per student per year, plus an initial setup integration charge of £30,000 for early adopters. In the UK, there are 282 higher education institutions teaching around 2.5 million students. So the total addressable market in the UK is 282 times £30,000, the one-off implementation charge, or £8.4 million, plus £10 for each of the 2.5 million students per year, or £25 million a year. Initially, we'll target those universities without a current capability, i.e. the 47. The global potential outweighs the UK potential significantly. We will first look towards English-speaking countries, or those that teach predominantly in English. According to Statista, outside of the UK, there are 8,055 universities teaching nearly 42 million students in English worldwide. This gives us an addressable market of £242 million one-off, plus £420 million per year based on today's pricing assumptions. This is significantly more if you take on the CAGR expectation of 20%. The rest of the world, some 15,400 universities that teach the remaining 206 million students, would make a tertiary market over time. Alternative markets, such as further education establishments and schools, could expand this potential further, at least doubling it. Activity to date has been centered around research and development. The Expede Group consists of 4 distinct focused areas, and each has contributed to the development of the Yada Campus concept. We have a great team, many of whom have worked together for many years. Together, we have the skills, experience, and route to market to make this project a success, and would love to have you join us on the journey. In this round, we are looking to raise £1.25 million in exchange for 20% equity in ordinary shares in Expede IT Solutions Limited, the Effective Group company. This sets the pre-money valuation of the group at £6.25 million. The funds will be used as depicted here. £500,000 will be used on the next phase of development, taking the platform from proof of concept through to the production-ready MVP. £350,000 will be allocated to the sales and marketing effort, the recruitment of 3 dedicated business development staff, launch campaigns, exhibitions and conferences. £250,000 will be allocated for supporting our expansion with the development of support infrastructure and expansion to other geographic regions, and £150,000 to cover working capital whilst we expand. Should we be able to raise the required capital by the end of the year, then we'll be able to hit the milestones as shown here. We are currently on target to launch our simulator of the platform within the next 6 weeks, and we'll use that simulator to garner feedback from our students and university client user forums. Our Yada Events app, which if you remember will be the basis of the Campus Student app, will be used at our Freshers Festivals in September and October this year to bulk test client onboarding, registration and checking into events. We anticipate more than 20,000 participants at our events in Glasgow and London over 2 days, so this will be a good test of the onboarding process and infrastructure. In the UK, the higher education exhibition and conference season runs from January through to March, and we intend to be production ready for that season with our first iteration MVP. We will take speaking slots wherever feasible to demonstrate the platform and show thought leadership in the student engagement, profiling and intervention space. By April 2022, we expect to have our first conversations with potential early adopters of the platform with a view of onboarding our first client by October next year. The cycle then repeats year on year, but as more clients on board, more will want to join them, and so the pipeline will build, as will the team, the infrastructure, and eventually our target territories. So there you have it. We have the right product to solve a real problem that exists across the higher education sector globally today. We have an experienced, diverse and skilled team dedicated to making this happen with access to the sector and a realistic plan to take advantage of an expanding global market. The ask is realistic, we feel, for a company that is in both revenue and profit and has already embarked on the journey. Investment will increase the pace, and we hope you'll join us. Thank you for taking the time to listen to us today. We welcome questions and feedback and look forward to hearing from you.
Hi, thanks for watching our presentation from ScreenCoach. Now, this whole idea started at a barbecue at my place. A whole lot of parents sitting around complaining like they do around Australia and the whole world about kids and screen time. We'd all tried a few solutions, but we're clear there was a gap. It got me thinking. I've been working with business owners now for the last 15 years. One of my clients was Peter. He had 2 IT companies when we worked together. He was able to grow, sell and exit those companies and semi-retire in his mid-30s. I respect him about his business and IT knowledge, building companies. I spoke to himself and his wife, who has a master's in psychology, Stephanie, and they too agreed there was a gap and something needed to be done about it. And together over a few weeks, we discovered and came up with ScreenCoach. Now, the parents have been complaining about it for a while, but the data coming from the experts is pretty clear. The impact of screen time on kids' mental health, their weight, their lack of participation in sport. And even in 2020, with the onset of COVID, screen time doubled for kids as we still continue to do lockdowns around Australia and around the world. So the first place is to really identify what the true problem is. From our focus groups with parents, educators and psychologists, we quickly discovered there were big problems. One is the device merry-go-round. Hey, get off your Xbox, and they pick up a tablet. Come on, mate, get off the tablet. They pick up a phone and it goes around and around. And the most fascinating thing was the actual problem isn't screens so much. It says that it results in an explosion around screens. Get off your iPad and do what I asked you to do 15 minutes ago. So parents started to report it was actually the Groundhog Day of life, which is the challenge. It's coming home saying, whose shoes are these? Whose turn is to empty the dishwasher? Have you done your homework? Piano practice, and goes on and on. Then we interviewed kids. They really were clear about the fact that they hate the tension they put in the family around screens, making parents to be the screen time police, but it's a necessary evil to get what they want. They also hate they have no say in the matter. And both groups agree some kids will do anything for screens, some kids will do anything for pocket money. That started to shape a view of what we needed to do to build ScreenCoach, to really knock it out of the park. So what are we? We're a reward system where kids can earn time from the range of things and choices they make. It could be movement, from an activity tracker or watch. It could be from chores and tasks. And this is where it gets interesting in my adult behaviour change background. Because with ScreenCoach, if you empty the dishwasher, you might get 5 minutes. Do it without me barking, reminding or nagging, 30 minutes. Whatever it takes for a child to make a different choice. It's gamified. It's using that current gaming culture that kids love so much to work with them. Gems, tokens, pocket money. As you go through different levels, kids can get bigger rewards. But of course, going through different levels equals different choices and different behaviour change. Everyone wins. And then it's the distribution of this. ScreenCoach, this is what sets us apart from our competition. With ScreenCoach, you can get your time and credit you've accumulated can be paid out in either pocket money or screen time. We have software that you put on your devices, your phones, your tablets, your laptops. But again, what separates us even further from our competition is a hardware box that we've built. Plugged into the TV, this can block anything connected to the TV or downloaded. Think of it, Xbox, PlayStation, the binge watching of YouTube and Netflix, so prevalent in that teenage female demographic. When we look at our competitors, they all have single focus solutions that manage a small part of the problem. But with ScreenCoach, we're looking at the whole solution. But if you really want to know what the true secret is of ScreenCoach, what we found from our alpha trials is that it's driven by the kids. You see, all the other solutions we're talking about here, it's just another task management system for the parents to manage. So you have to see that the kid has done the task and then manage it through the program. But with ScreenCoach, because the payout's so high, the kids drive it for you. It takes all the tension out of the family. It stops the nagging and the endless arguments. We work online and offline. We work on all devices and break that merry-go-round. We reward in both screen time and money, and it's low touch for parents. That's the chasm that ScreenCoach is looking to cross. Getting away from single focus solutions and moving to a complete solution that's comprehensive and manages for all families. So far we've received $1 million from the government through the Accelerate Commercialisation Program. That's with no equity and no requirement to pay that money back. Last year they gave us $330,000 to take ourselves through the alpha trials. Based on the success of those alpha trials, this year they've given us $670,000. The plan is with that to go through our beta trials and go live by the end of this year. The Accelerate Commercialisation Program is a dollar match funding program, which is one of the triggers for our current raise. Though so far we have raised $660,000, including $100,000 from the founders. Our company is SEC compliant, and that means your investment will get a 20% tax rebate immediately, and your investment is capital gains tax exempt. The raise we're doing is $1.5 million, with a company pre-valuation of $4 million. We're using two mechanisms for the raise, $500,000 in equity and $1 million in safe notes. We're looking to grow those buckets at an equal amount of $1 of equity to $2 in safe notes. This gives us a $120,000 cash burn rate and a 14-month runway. Our actions for this investment is very simple. Beta trials, go live at the end of the year, and lock out our competitors. So ScreenCoach is a SaaS-based model, subscription-based. $12.99 a month for a family to manage all the phones, tablets, laptops, and desktops, or $99 a year. The hardware box, $149, is a once-off payment that once plugged into the TV will manage gaming consoles, streaming, downloaded TV, and any device really plugged into that TV. We see it as about 20% of our market going forward, but a huge opportunity not to miss out on. And when we start looking at opportunities, the NDIS is a huge one for ScreenCoach. It's often known that children with ASD, autism spectrum disorder, are highly wedded to their devices, so much so that therapists often use it as a mechanism to help shape behaviour change for these ASD children. Hey Johnny, if you do X, Y, and Z, you'll get some extra screen time. The challenge they face is that it doesn't always play out outside of the therapy room. With ScreenCoach, they have the opportunity for them to be able to set the system so it can work for the children 24/7. There's also an opportunity in the law courts in separated homes. Often there's tension around finances and communication, but one of the simmering ones that's not being managed right now is screen time and electronic devices in different houses. With ScreenCoach, it's something that can be court-ordered, mandated, to put ScreenCoach in the house to help manage that stress. To give you an idea, just recently we did a little media push, and from our one program on a current affair, we have 683 people who said, I'm glad you're doing beta trials, but I just want to buy it now. That translates into $100,000 at the end of this year, or quarter two in the 21-22 financial year. We have 3,800 people who signed up saying they want to be part of the beta trial. Another potential revenue of $420,000 in our first year going forward. The government's come in with a 12-month subscriptions to use ScreenCoach for underprivileged families who can't afford the solution. It's $15,000 now, but a great opportunity for us to work with governments and one of our strategies moving forward. And to give you an idea of opportunities going forward, one of our beta trial partners has 3,600 kids who are NDIS funded with ASD families. They say that if the solution is under $200, a click of the button and the software will be distributed to the families that need it. With that one provider alone, there's an opportunity of $500,000. There are currently 164,000 families registered with ASD on the NDIS. Securing a third of that market would equal $9 million in recurring revenue. The law courts. Divorce homes, there's 50,000 divorces every year. Picking up a third of that market again has the potential of delivering $5 million in recurring and ongoing revenue. These are some of the market opportunities we look to lock out our competitors from being first to market. Now, talking to path to market, due to the success of the release and the program on A Current Affair, Channel 9 has discussed with us about becoming an exclusive launch partner. We'll also be running and growing ScreenCoach through all the classic digital marketing channels, Facebook, Instagram, etc. But the other opportunity and a way to leverage our growth quickly is for business-to-business partnerships. We have discussions with Harvey Norman, NIB, Belong, and Garmin, either from a retail partnership, joint ventures, and affiliate programs. We also have a strong program around referrals. Refer a person to ScreenCoach, get a 10% discount. Refer to 20%, and it goes on and on. A real opportunity for us to grow this business through word of mouth. And down the track, schools, a huge area that's been mismanaged in terms of screen time management. In the folder provided, we have a detailed 5-year forecast going through our general assumptions and marketing strategies going forward. Some of the key points to pull out is our break even in 2025 with a 25% net profit by 2026. You'll also see our strategies moving from the Australian, US through to Europe, other markets and into Asia, again by 2026. The company valuation growing from where we are now at $4 million up to $78 million over the 5-year period. This translates into a 20 times return on investment in 5 years. There are other vertical integrations for ScreenCoach as we go forward, through schools, ScreenCoach for adults, the family unit, and then eventually moving into aged care and hotel resorts as well. We have an amazing team at ScreenCoach to deliver on our forecasts. Peter's 30 years in the IT industry has put together an amazing team of tech experts. Stephanie again has been able to procure an amazing group of psychologists, educators and advisors to help us grow and shape ScreenCoach to meet our market needs. Yeah, our advisory board includes some people who have been very successful in helping take startups to exit. What's our exit? We see the opportunity for potentially an IPO in 3 to 5 years' time, or being bought out by one of the partners in the area. There's already been a lot of merger and acquisitions in the space. Or we can continue trading like many of the others in the space are doing and growing this into the big organisation that ScreenCoach deserves to be. We have a whole lot of IP strategy in play, which we're happy to share and discuss with you in private. But thank you for taking the time to look and find out more about ScreenCoach as an investment opportunity. Some of the key highlights: ASIC compliant, 20% tax rebate, and capital gains tax exemption. The $1 million from the government with no equity and no payback, based on the success of the results we've had so far. A 10 to 20 times return investment in 3 to 5 years has been demonstrated. First sales in the bank, and commercial partners ready to help us move and go forward. Thank you for your time. Look forward to speaking to you soon. Bye.
Hi to all the wholesale investors currently watching. Now I'm going to try to keep this presentation to about 7 minutes. The structure of the presentation will be as follows. I'll introduce myself, the problem, the industry solution, our unique solution, and then I'll go through some of our awards and grants along with our future plans. So first off, an introduction. My name is John Shannon. I'm the CEO and co-founder here at PostHarvest Technologies. I love this job, but I've not always had this job. Straight out of high school, I jumped into the New Zealand military. From there, I went on to start 3 tech companies, one which was PushPay, a SaaS model company, which has now gone on to be worth over $1 billion US. So that is a little bit about me. Now, straight on to the problem. It is an industry known fact that over 45% of all fresh produce is lost or wasted each year on the journey from the farm to the customer. That's around 1.3 billion tonnes of unused food, which is valued at over 700 billion in losses each and every year. That astronomical amount of produce not reaching the end customer will sadly be thrown into the ocean or stuffed into landfills. That accumulated methane and carbon release from that waste contributes to a larger carbon footprint than the entire airline industry. And if that problem wasn't big enough already, according to the UN, our global population is forecasted to reach over 10 billion by 2050, meaning that we need to double our food output in an industry which is already straining in all of its resources. So while doubling down on food production isn't on the cards, there clearly seems to be here an opportunity for the industry to be better stewards of all the resources we currently do have. The largest and longest stage of the food supply journey for fresh produce is with inside storage. And in some particular cases, particular foods can be stored up to 18 months. With inside these storage periods, over-ripening of fruit and vegetables is by far the largest problem and the biggest reason for waste. Which leads me on to current industry solutions. The industry solutions to this problem right up until now have been very poor. In fact, most of it can be summed up in basic guesswork. The most accurate industry solution to this point has been a gas chromatography machine. This is used to measure ethylene, the organic compound which was released through ripening produce. Now, while it may be the most accurate monitoring method, industry standard GC units cost upwards of $100,000, require scientific qualified personnel to operate, and unfortunately in many cases take weeks to get results back, rendering these results useless as rotten produce can affect surrounding produce in as little as 3 hours. Which leads me on to our solution. So the team at PostHarvest wondered, what if we could create a device which excels in all the areas that the GC unit falls short in? The idea has taken us over 4 years, millions of dollars, expert team, but I believe we've accomplished what we set out to achieve in our stage 1. We've created a multi-sensor device which can consistently capture atmospheric samples in order to read ripening contributors such as carbon dioxide, ethylene, temperature, humidity, and many other factors. These readings are then pushed instantly to a user-friendly software so that key personnel can look at it and determine exactly what they need to do 24/7. The sensitivity of our product can allow for predictive readings up to 9 months in advance. This level of forecasting has simply not been seen in this industry right up until now, and this can equip decision makers with the knowledge necessary to send out shipments in very optimal times, knowing that every crate will reach its final destination in a healthy way. This device has the capability of saving the industry hundreds of billions of dollars each and every year, yet our pricing model is a lease model at $8 per day, which will pay itself off almost instantly. This technology is going to change the entire industry. It's going to prevent huge industry losses. It's going to reduce carbon emissions. It's going to increase outgoing supplies, and the industry has already begun to take large notice. Awards and grants. Since launching our prototype and conducting university trials, PostHarvest have won innovation awards across a number of different categories, as you can see here. We've also been featured on Behind the Scenes with Lawrence Fishburne, airing on such networks as CNN, Fox News, and CNBC. Now, while winning such awards and recognitions, we've also been awarded multiple grants and tax incentives for our work in the field, which covers large portions of expenditure in categories such as research and development, commercialization, and international promotion. We currently have 30 major strategic clients wanting trial to buy units, representing over 500,000 potential sales at $8 a day. A lot of these names are household names and local supermarkets that you may know. Last month, we had the largest North American reseller and distributor with Inside AgTech wanting to on-sell our devices on a commission basis as well. This leads me on to our future plans and projects. We currently have around 20 investors on board, ranging from family members to professional investors, including myself, which has put down over $1 million on the project so far. This is actually the first time we've done something like this, where we're opening it up to people outside of our immediate circle, and most likely will be the last time we do a major raise like this one. We have expression of interest since opening it up from multiple people and VC firms, including a couple of firms that are watching right now. Hello to you. And I'm pleased to announce that as of today, we are currently committed to raising $1.5 million. These funds will be matched with our other grants and our other funds, totaling in over $3 million. And over 86% of the total funds will go directly into manufacturing and installation of our first 1,000 units, which have already been requested. The funds we make back from this initial batch will very quickly pay themselves off and allow us enough funds to build our next 10,000 units and then our next 100,000 units and so on and so forth. Our mission ultimately is to work with the top 100 organizations inside our field, which represent nearly 80% of the entire industry and millions of call rooms globally. If we can work inside each one of those ones, it will make a significant impact to the global food supply and reduce carbon significantly. In summary, we have a very unique and multi-patented device in a sector which is rapidly growing, a world-class engineering team which specializes in gas calibration, micromeasurements, algorithms, and has a proven track record on 3 multi-billion-dollar companies. We have a large market desire, interest from household names, proven distribution channel, multiple grants, industry awards, and sophisticated investors on board. Now, if you're interested in being part of the journey with us, I'd very much like to have a phone call with you and go through any questions you may have. Wholesale investors, thank you for your time, thank you for your attention, and thank you for your interest in solving a global problem. Cheers.
Hello, everyone. I'm Jordan Keeval, and I'm here to provide you with an investor update from Calima Energy. So the new Calima is a conventional oil and gas producer focused on assets in Western Canada and listed on the Australian Stock Exchange. We have 3 core areas in Western Canada. Those core areas are known as the Montney, the Thorsby area, and the Brooks area across the 2 provinces of British Columbia and Alberta. It's a snapshot of some of our corporate highlights. We trade on the ASX under the symbol of CE1. We've got about $103 million market cap currently in Australian dollars. Net debt for the corporation is $14 million on a $25 million credit facility. We have very low operating and transportation costs of $10 per barrel Canadian, as well as a very low break-even cost of $26 US WTI. We're currently forecasting to average 3,700 BOEs per day in the second half of 2021. And the reserves for the corporation are made up of 5.4 million BOEs of PDP reserves, 22.5 million BOEs of 2P reserves, as well as 192.1 million BOEs of 2C contingent resource associated with our Montney play. We are forecasting for calendar 2021 to have an operating cash flow of 31 million dollars Canadian. The current guidance for the corporation is to exit this year, 2021, at 4,500 BOEs per day, and that was increased from a previous forecast of 3,400 BOEs per day, as rising oil prices as well as well performance exceeding our expectation. We were able to increase our 2021 guidance by over 1,100 BOEs per day. And in 2022, we're currently forecasting to produce 5,500 BOEs per day by the end of the year. That will result in $46 million of EBITDA by the end of 2022. And we're going to be spending $33 million of CapEx in next year, 2022, to complement the $20 million of capital program for the second half of this year here in 2021. As a result of our rising production rates, we will have significant free cash flow. And that free cash flow, while we're growing production, is actually going to reduce our debt. We're going to go from $14 million of debt currently to 11 by the end of this year, and only $2 million of debt by the end of 2022 when we're producing 5,500 BOEs per day. Calima is very focused on ESG. We have a great record on the environmental side as well as the social and governance side of things, as this will continue to be a focus and increased focus for the corporation on a go-forward basis. We're also very attractive when you compare our valuation to some of our peers. On an enterprise value to 2P multiple ratio, Calima is currently at about 4.4 times. If you compare that to our Toronto Stock Exchange peers, who average about 7 times, or our Australian Stock Exchange peers, who average about 12 times EV to 2P multiple, Calima has a very attractive advantage right now for investors to capture some of that value on an EV to 2P multiple. The growth plan here consists of drilling wells in Brooks and Thorsby, the 2 assets acquired from Blackspur Oil Corp, the Canadian private company, earlier this year, as well as on the longer term horizon, either a development of the Montney assets or a divestiture of the Montney assets. But when we hit 5,500 BOEs per day sometime next year, we will have a great deal of optionality in that we can either continue to develop the Alberta assets acquired from Blackspur, as they have the capability to be scaled up to about 10,000 BOEs per day, or we can also concurrently develop the Montney assets, which have the ability to be scaled up to 11,000 BOEs per day based on the current infrastructure that Calima owns in the area. Very torquey to commodity prices at $70 WTI. Our anticipated EBITDA at 5,500 BOEs per day is $68 million. And if oil goes to $80, in 2022, our anticipated EBITDA is $83 million based on 5,500 BOEs per day of production. The management team and board is a combination of the Calima and Blackspur teams, as well as the board of directors is a combination of Canadian and Australian directors. The 2 areas of Brooks and Thorsby, we currently produce 2,000 BOEs per day in the Brooks area, about 850 BOEs per day in the Thorsby area. And the reserves, the 22.5 million BOEs of 2P reserves previously mentioned, that consists of 11.6 million in the Brooks area and 10.9 million in the Thorsby area. Brooks is characterized by a very shallow depth target formation called the Sunburst Formation. Calima just finished a 4-well drilling program in the Brooks area. Gemini 1, 2, 3, and 4 were the names of the wells drilled. And those wells are just being brought on production right now as we speak. It was a very successful program. We're very excited about it and very much looking forward to that new production coming on. That production is quite economic at $70 WTI. In fact, the Sunburst Formation, because it's only $1 million to drill, complete, equip, and tie in those wells, because there's no frac, they have a greater than 500% rate of return. less than a half of a year payout, and a $4.2 million NPV10 value for a conventional unfracked sunburst well at $70 oil. These are some pictures showing what the area looks like. As you can see in the Brooks area, it's agricultural, it's flat, it's a very ideal area for oil and gas development. Pictures of some of our facilities, all new, all built by Blackspur, all with significant room for increased production and increased throughput. These were designed for growth. Moving into the Thorsby area, where we have an upcoming drilling program starting next week, actually. We're planning to drill 3 wells, Leo 1, Leo 2, and Leo 3, right in the core of the what we call the Thorsby main pool. And we're also considering drilling some 50% working interest wells in North Thorsby, which would be designated Leo 4, 5, and 6. We may drill 1 or up to 3 wells in the North Thorsby play, subsequent to our upcoming drilling program with Leo 1, 2, and 3. The target formation is called the Sparky in the Thorsby area, and it's $70 oil and $2.5 million well costs. These are fracked wells. They are a little bit deeper, they are a little bit longer, and they are fracked, but they still generate a greater than 500% rate of return, less than a half of a year payout, and $7.8 million of NPV10 based on our Tier 1 type curve and utilizing $70 oil assumption. Also, to complement our 2 producing areas in Alberta, we also have the Montney acreage. The Montney is a world-class, unconventional gas play, liquids rich, compares very favorably to other unconventional plays across North America. And in fact, Calima has 60,000 acres of Montney acreage in the Northeast BC area. Calima drilled 3 test wells in 2018, proved up the resource, bought some facilities. The Tommy Lakes facility consists of a gas plant and 2 compressor stations. And upon full development of this play, Calima can ramp it up to 11,000 BOEs per day of liquids-rich gas production, utilizing its 100% owned infrastructure. There's also been a significant amount of consolidation in what's known as the Northern Montney play. So again, it lends itself to Calima just having great optionality. We can divest of the Montney acreage and redeploy that capital in our oil assets on the Alberta side, or we could partner with somebody and develop it ourselves. But with all of the consolidation and interest in the area, Calima is very pleased with its current optionality in the Montney fairway. The reason Calima is a must own is we have free cash flowing assets, particularly into 2022, where our free cash flow will be so great that we will be eradicating our debt and becoming debt free and starting to put cash on the balance sheet. There's significant upside in all of our assets, Brooks, Thorsby, the Montney fairway, and we can also quickly respond to rising oil prices. We have a spud to on-stream time of between 30 and 60 days in the Brooks area. And when oil prices are high, we're going to drill wells and bring them on quickly. I thank you for listening today. Please visit www.calimaaenergy.com. As well, remember our stock symbol CE1 on the Australian Stock Exchange. Thank you.
Good afternoon. My name is Dick Stoneburner, and I am proud to be the chairman of Tamboran Resources. I've been lucky enough to be in the oil and gas industry for over 35 years, and it's fair to say I've seen a lot in my time. I have served in a number of roles, from exploration to operations to senior management in conventional and unconventional energy. I've seen a lot, but energy as a whole continues to evolve, and this is one of the most exciting times of my career. Tamboran Resources is a company that has the potential to make a huge impact on the energy mix of Australia and the wider Asia-Pacific region, as well as playing a role in decarbonizing the world. Let me first tell you a little bit more about myself. I'm a former co-founder of Petrohawk Energy Corporation and served as its president and chief operating officer. PetroHawk was the developer of what became known today as the Eagle Ford Shale in South Texas, one of the largest and most successful unconventional reservoirs in the lower 48 states of America. We were the first company to drill and complete a commercially successful well in the core of the play, and were one of the preeminent operators. PetroHawk eventually merged with a much larger company, BHP Billiton, where I served as president of the North America Shale Production Division for BHP Billiton Petroleum. I'm equally proud to be on the board of the Switch Energy Alliance, which is a not-for-profit organization that is a leader in educating the world on the energy transition, as well as a leader in addressing energy poverty throughout the world. Tamboran and the Beetaloo Basin more broadly represents an opportunity to invest in next-generation energy on a global scale. And it is located in a country that is quickly transitioning from coal to cleaner forms of energy such as natural gas, which will be integral in addressing climate change in the Asia-Pacific region. The quality of the reservoir being targeted under Tamboran's acreage is the core of the Beetaloo. In fact, it's the core of the core, the best of the best. In fact, this opportunity is as good or better than any shale play I've ever been involved with. Others have made this comparison, but there is truly a reason to compare the shale reservoir in the Beetaloo, and specifically Tamboran's acreage, to the Marcellus Shale in Pennsylvania, which is recognized as the most prolific gas shale reservoir in the world. The Tamboran acreage represents similar scale, in excess of 100 plus TCF, and similarly high-quality reservoir properties as the Marcellus Shale. Simply stated, we believe Tamboran's time has come to become the true leader in the Beetaloo Basin. Tamboran will be the true leader by not only aggressively developing the resource, but also by utilizing industry best practices that made North American shale operators so successful. The board and management of Tamboran, led by our managing director, Joel Riddle, have deep technical knowledge and operational experience in developing and commercializing large-scale unconventional gas assets in the United States. My experience with PetroHawk is a classic example of aggressively developing a resource and using best practices. In 2008, we didn't have a single molecule of unconventional production from the Eagle Ford, Haynesville, or Permian shale plays in North America. However, by 2011, when we merged with BHP, we had literally created billions of dollars of value, and America had turned the corner on its reliance on foreign oil. Like mobile phones leapfrog telephone poles, Australia has the opportunity to apply the technical learnings from North America over the past 2 decades to accelerate the development, what we believe will result in a significant low CO2 resource in the Northern Territory. We will not only lead with technology, but the environmental impact will be minimized by adhering to the best practices that have been established under decades of environmental scrutiny in the United States. Tamboran has committed to be a net zero carbon emitter once production has been established, and will support the transition to net zero emissions in Australia and the Asia Pacific. This will be done through integrating renewable forms of energy in the field and utilizing carbon offsets for our equity share of Scope 1 and Scope 2 GHG emissions. The quality of the gas from the Beetaloo, with only 3% CO2 content and no other impurities, is also unrivaled in terms of being a clean and low CO2 option for Australia and the Asia Pacific region. Beyond the quality of the resource that exists in the Beetaloo, what equally excites me is that Tamboran has multiple commercialization pathways to market. These include Tamboran's joint venture agreement with Jemena, which allows for the completion of a gas pipeline to bring gas to the local Northern Territory market as early as 2023-2024, and ultimately to the Southeast domestic Australian market by 2025. Additionally, a hugely exciting opportunity for Tamboran exists in South and Northeast Asian export markets as well. Natural gas demand in Northern Asia has grown at a rate of 7 to 8% per annum over the last 10 years. In the next decade, Asia's demand for high-quality, clean, and low CO2 gas is going to continue as it looks to decarbonize away from coal. Tamboran's ability to link with LNG supply hubs in Darwin and Gladstone will be key to servicing that demand, and it is only 3 days via LNG tanker from Singapore and 9 days from Tokyo or northern China. Both state and federal governments across party lines agree now is the time for low CO2 gas and for the Beetaloo to fulfill its promise. The Beetaloo Basin has been earmarked by federal government as highly strategic for the future direction of Australian gas supply, with significant upside potential to convert multi-TCF resources into large 2C resources and 2P reserves. The Australian Competition Regulator, the ACCC, specifically identified the potential of Tamboran and its JV with Jemena as a priority development to address high costs and combat anticipated domestic gas supply shortfalls by 2024. This is energy security, and we are watching it evolve every day. Furthermore, in December 2020, the Australian federal government announced $50 million in incentives for the industry to accelerate gas exploration and development in the Beetaloo Basin. In closing, this is an incredibly exciting time for Tamboran and for Australia, as exciting as any in my career. I am truly glad to be part of Tamboran Resources and welcome you to join as well. Thank you once again for your interest, and I look forward to you joining us on this exciting journey.
Hello and welcome to Star Minerals. I'm Greg Armand. I'm the CEO-elect of a new resources company, here to explain what we are and what we're about. So I'll step you through this presentation and give you an overview of the company and the opportunity. What we'll talk about today, just quickly, the corporate overview, board and management, the structure, the projects that we have, the timing, and the indicative budget that we've got in place. So where we are is in Meekatharra in Western Australia. We've got the advanced gold resource at Tumblegum South, 40 kilometres to the south of Meekatharra, and the West Briar exploration package, which is 140 k's to the north. What we've got, basically a perfect mix of an advanced, ready to go gold project and a more blue sky further down the track. We'll be doing a lot more work on the West Briar. And why we're doing it, obviously gold demand remains really strong and copper is at record highs. So two good commodities for us to be involved with. Who we are, we've got an experienced team of mining, exploration and finance professionals that have been involved in mining operations and public companies for a number of years. And when we're going to do all this, as quickly as possible. We're already on a mining lease with Tumblegum South, and the intention is to get all the approvals work that we need done as quickly as possible so we can get the asset into production. So who we are, our chairman, Ian Stewart, is also the chairman for Briar Resources. He's a geologist by trade. He brings with that obviously, mining and exploration experience, as well as having spent a number of years working on the finance side of things. He has good experience in both Australia and overseas with a number of listed companies. Ash Jones, who's one of our non-executive directors, he's currently exploration manager for Briar and for Australian Vanadium. He's got vast experience specifically of the area that we're going to be working in, and also wide experience in Africa and Australia. He also has an excellent mining background and a very strong finance background as well. And Stephen Struble, who's the other non-executive director, he comes to us from Melbourne. He's got a very strong finance background, having worked in the markets for a number of years. And he's also been a company secretary and director for a number of ASX listed companies. And myself, I'm a geologist by profession as well, with a background in operational and technical roles. Most recently, I was working for Fortescue Metals Group, principal geologist with the business development team, looking at a whole range of opportunities all around the world. I won't go into too much detail on the corporate overview. The prospectus is the best place for this, really. It sets out exactly what the terms are. But yeah, suffice to say, it's a tightly held structure. You'll note that there's a large number of shares that are offered to the vendors, and there are performance shares that will go to those vendors as well, based on a number of metrics. But basically, the logic is that they're incentivized to make sure that we have success, and you know, they will be assisting us wherever possible with that. So just a quick overview on the projects. As I said, either side of Meekatharra, Tumblegum South, the gold resource ready to bring in production straight away, and the West Briar, the exploration package. Tumblegum South, you'll see the dotted line along here. That's basically the trend line extending from the deposits to the north. You'll see the old mining pits there. That was the Gabonint JV, worked on by Dominion Mining from 87 to 1992. That produced around 150,000 ounces. It was a nice, profitable little operation. Tumblegum South is basically the continuation of that. 2020 was when the maiden resource was announced, sitting around 614,000 tonnes with a grade of around 2.24 grams per tonne. Current focus obviously is on the gold that's there. There is copper in the system, so potentially that may be of interest to us further down the track. The priority here is to work towards further drilling of that resource and completing the needed engineering and environmental work to get the project into production. Just a quick overview of the geological setting there. The main feature that I'll notice is around here in the Gabonint Share. You'll notice a number of current and former mining operations of both gold and copper. So that's why I mentioned the copper before. There's a lot of copper in the system, and certainly there's potential there to follow that up. Just a quick view, cross-section through some of the drilling that was done in 2019. Basically, the takeaway from this is that those lode structures are still open at depth. So part of the future drilling work will be to follow them down dip, and also the thrust fault that we have identified. We'll be looking to find the other side of that and see if we can find a repetition of the ore body. The model was based on 49 RC drill holes. We also drilled 3 diamond holes late last year. The gold recovery is in excess of 90%, based on the test work we've done. That's also in line with the historical results from the old mining operation. We have an indicative shell that's been worked out. It is just on the scoping study though, so we do need to do some more work on that before we can prove it right up. We have had a development agreement in place. We're currently negotiating to extend that and make sure that remains current. But we have a number of partners in the area that are keen to take the ore that we're going to produce from this. It will, come out a good grade and will be a very good sweetener for a lot of those operations. So we have no shortage of people to partner with. That obviously means that we don't need to build our own gold plant, which means that we're going to have a very low capital cost here. Just another overview of Tumblegum South. You'll see the previous mining phase through there. You'll also notice the black dots here. Basically, they're the collars from all the drilling that we've done. One thing to note, that's not the whole lease that's been covered, so there is still plenty of exploration work to do, even though it's only a small lease. We've got some things to follow up. You'll see the yellow arrow there is basically showing a trend that we've identified out towards the west. So when we get up there and start drilling again, we'll be able to follow that up and hopefully identify some more ounces to go into the resource that we've already got. And speaking to that resource, obviously there's, the intention that as we drill more holes, we'll be able to increase the confidence of these numbers and basically what we have here is the indicative sort of scoping study level pit shell that we've got in place. If we can increase that resource, we'll obviously be able to expand that pit shell or potentially look at an underground resource further down the track. Note that the deposit is still open at depth, so further down that plunge line, there will be hopefully more material for us to find. So the West Briar project is quite different in character to Tumblegum South. West Briar is a far earlier stage exploration package. We've got quite a large collection of tenements here. We've got 7 tenements, 349 square Ks. Probably the most interesting part of it is that we've got 45 Ks worth of Narracuda by strike in our tenement package there. The Narracuda formation obviously has been fairly prominent for anyone that's followed the story of Sandfire. And basically here on the far side of the Briar Basin, where the material has been faulted and folded and smashed up against sort of the hard parts of the craton, we've seen a lot of interesting structures there and a lot of different phases that provides some really exciting targets for us to follow up. Slightly wider overview of the area. Here's the DeGrussa and Monty deposits that I mentioned before on the other side of the kind of anticlinal structure here centered around Peak Hill. You'll notice a number of current and former operations in the area. There's been a number of quite rich mines. Peak Hill was one of the richest mines in Australia during historical gold rush times. But it was an alluvial mine, and that alluvial cover that sits over much of this material is part of the reason they've had problems. It's meant there was only limited kind of exploration, only really starting up again in the late 60s. That deep cover meant it was hard for people to follow up. There are some interesting historical values to follow up in rock chips and soil samples though. So we find the area to be very prospective, and we're very keen to get up there and get into it. Our indicative budget pretty much follows along the same theme we've been talking about. Tumblegum South is obviously the spending priority. It's where we're going to put our most efforts in the early stage of our life. The intention is that we can spend the money there, get the deposit into production, and then that will provide a war chest for our further activities. So the West Briar, basically after year 3, year 4, years onwards, a lot of that will be funded by the resulting cash flow from Tumblegum South. So our timing for all of this, as I've mentioned, the first steps obviously are to get Tumblegum South approved and into production and realise the value that we've already got in that asset. The next steps obviously is to expand our activities in the West Briar. So just on that, we quickly start, basically our resource drilling commences at Tumblegum South. We work through to get the mining approvals, all of the documents submitted, make sure the engineering and scheduling works based on whatever project partner we're going to be working with. And hopefully by sort of early next year, we'll be starting to mine and starting to make ore sales. In parallel to that, we'll be undertaking the exploration activities in the West Briar. And obviously as we work our way through that, we'll be able to provide updates and continual news flow of what we're up to. So that's where we're at. Currently, we're going through the IPO process. So if you'd like to know anything more, please visit the website, starminerals.com.au. My contact details are up there as well if you'd like to call or email me and learn how to get involved in building the next best Australian gold mine. Thanks.
Hello, ladies and gentlemen, and welcome to the White Rock investor presentation, where I will give you a bit of a story about White Rock and what we're up to both here in Australia, but also over in Alaska. You will find this presentation on our website, and so I encourage you to go and have a look at that if you are after more information. And there is also the ability to ask questions at the end of this presentation with wholesale investors, but also through our AdInfo website. So what is White Rock? On one page, we are ASX listed. We also have a cross listing on the OTCQX in the US. We have two major projects. One we call Red Mountain, which is a silver-rich zinc volcanogenic massive sulfide and gold project in central Alaska. And we also have an advanced gold and silver project here in New South Wales. And excitingly, a third asset joining the White Rock stable, Ozstar Gold, a Victorian gold explorer and producer. And I will touch on these three assets in the course of our presentation. So a little bit about Red Mountain, Central Alaska. For those that understand the language, it's already got a significant resource of over 9 million tonnes, grading either 13% zinc equivalent, because zinc is the dominant metal, but looked at the other way, grading 19 ounces per tonne silver equivalent, given that silver and gold are of equivalent value to the zinc, and a very large land package, 836 square kilometres. So very prospective for zinc, silver, lead, gold, but also gold in its own right, a large anomaly that we call last chance. Fully funded, 2 to 3 drill rigs going, started in May. Mount Carrington, it's an advanced gold and silver project in New South Wales, has a feasibility study, has a JORC resource, has a JORC reserve, and we're in joint venture with ASX-listed Thomson Resources, where they will manage that project and advance it through the approvals and take the pre-feasibility study through to definitive feasibility study, all the while White Rock is being free carried. So a bit about the people managing the company and shareholders' money. Peter Lester, mining engineer, same as myself, different skill sets. And we have Jeremy Gray based in London, again, a different skill set. So small board, but deep experience and broad experience, which I think is important for the investor and shareholder, and ably supported by Rowan Wallen, our exploration manager, with broad experiences both in North America and here in Australia. And then importantly for White Rock, we have a technical advisor. Many people may have heard of Dr. Quinton Hennig. He's been great at the geological technical advice level, but also at the corporate level, introducing us to the North American market in particular, given our significant Alaskan asset. A little bit of a dig at geologist, very creatively, imaginatively named Red Mountain Project, and it's exactly right. So where are we? We're in central Alaska, about 100 kilometres due south of Fairbanks. As I mentioned, very large land package, a great initial JORC resource, great grades, not a lot of exploration done until we acquired it 4 years ago. When we acquired it, it was only 15 square kilometres in size, and we've been encouraged each year for the 4 years we've been on the ground. It's now over 836 square kilometres. Couldn't do it without a great team, and certainly in this COVID world, guys based managing it out of Fairbanks, Carl and Sam in AI. You can see one of our camps in the middle. Drilling season generally from around end of May to somewhere around mid-September. All chopper supported, but great guys on the ground. Some of the historical work, you can see some of the very large widths and some of the great grades that this deposit between Dry Creek and West Tundra Flats offers us when we acquired it. So what are we doing this year? We'll be drilling underneath that known deposit at Dry Creek. It is open along strike and down dip, so one drill rig will be there. Second drill rig at this stage will be moving also to the western part of our tenement package to drill some of these VMS targets that have never been drilled before. We only announced these earlier in the last year or so. And also drilling deeper holes at our last chance gold prospect. So they're the three targets for this year's exploration program. So the first of those, the Dry Creek deposit out in the east that I mentioned, we did some drilling there in 2018, had some fantastic drill hole results. So we're going to be back there this year drilling deeper holes. We've had one or two already done. As those results come to hand, we'll be releasing them to the market, of course. So we're quite excited about what this drilling offers, given that the deepest holes only went down about 200 metres, and we've had some great intersections to date. So we're looking forward to that work. There's a bit of a diagram of the known deposits in the colour shapes there, and our proposed holes, somewhere between 5 and 7 holes we plan to be drilling there, and that started in late May. But also in this area, there are deposits that haven't been drilled, and we've been using geochemistry and geophysics to identify where they might be. And you can see that we've got some great target areas, both southern limb targets and to the north. So currently we're focusing on the southern limb targets. And here's an example of some of the geophysics works that has identified a possible VMS horizon. The only real way to tell is to drill test it, and that started in early June. So one rig on the known deposit at depth, one rig on these VMS targets that have never been drilled before. So no guarantees in exploration, but applying geophysics in geochem and mapping and sampling by the team of geologists on site, very exciting times. And then thirdly, these VMS deposits out to the west, only announced in the last year or so, and we think there's at least one drill target right now that we would like to put a drill on. The beauty of the Red Mountain project, it sits in a fantastic geological jurisdiction. It has these VMS deposit potential and known at Dry Creek and West Tundra Flats, offering us a great exposure to zinc, silver, gold and lead. But we also sit in what's known as the Tintina Gold Belt, which is host to significant gold deposits. Many investors may have heard of Pogo, recently purchased by Northern Star, an Australian company. It's host to the 45 million ounce Donlin deposit. So we're in a great geological domain, blessed with two of these opportunities, gold alone, and we call that our last chance project, but also the VMSs. So we only discovered this last chance project deposit about a year ago, significant size, about 15 square kilometres. Last year, we got on the ground, we mapped and sampled it, and we moved very quickly to be able to get some CITA holes into it. So from January last year to July last year, we went from announcing it to drilling it, so in 7 months. So moved very quickly. The drilling suggested to us that we needed to drill deeper. So our third rig for this season is planned to do exactly that, is to drill deeper than we did last year to see if we can find the source of this gold anomalism. But White Rock is more than just the Alaskan asset. We're in the process of acquiring Ozstar Gold. It's a Victorian gold explorer and producer. It has a gold processing plant. It comes with 670 square kilometres of highly prospective underexplored ground. Victoria is going through a gold renaissance thanks to the world famous Fosterville mine run by Kirkland Lake. So we're very excited to be able to pick up an asset in this part of the world that offers news flow around the clock, around the calendar year, not just an Alaskan summer, but also is underexplored. And also in a COVID world, I think bringing a project back closer to home, given we are Australian based, I think is also important for the shareholder. And thirdly, but not lastly, our joint venture, our Mount Carrington project that we've joint ventured, gold and silver, JORC Resources, JORC Reserve, we're in joint venture with Thomson Resources, where they will advance it through the approvals and take the study to definitive feasibility study level. White Rock gets free carried through that, so the White Rock shareholder maintains exposure to this asset, whilst Thomson spend the money to advance it, and all the while allows White Rock to also focus on its Ozstar acquisition and also the exciting program that we have going on in Alaska. Our corporate structure, you can see our share price hovering around 50 cents, good cash on hand, a great shareholder spread internationally and in Australia, US-based, European-based, high net worth and institutions. So a very good spread for a small junior. Again, I'd encourage the investor to have a look at who else has put their money into White Rock. So it's not just the board and management team that are managing your money that you should look at, but also who else has put their money in, who else has done their own research and seen what the opportunities are. So why would you invest in White Rock Minerals? Not advice, do your own research. But as I mentioned, the Red Mountain Silver Zinc Gold VMS, the Last Chance Gold target itself, both having drills on them as we speak, advancing the Mount Carrington Gold and Silver project in New South Wales, and thirdly, the acquisition of Ozstar Gold, a large tenement package, small-scale gold producer here in Victoria. And very importantly, again, I'd encourage the investor to have a look at the jurisdictions within which these projects sit. Very important. Sovereign risk is a big issue around the world. COVID is also a big issue around the world. So having projects that are manageable, first world jurisdictions, follow the rule of law, I think is very important aspects in anyone's consideration for investment. So with that, ladies and gentlemen, thank you very much. As I mentioned, you can find a lot of this and this presentation in particular on our website. I look forward to any questions you might have. Thank you very much.
Good morning, and welcome to Pioneer Credit's presentation for Wholesale Investor. My name is Keith John, and I'm the Managing Director of Pioneer. Pioneer is an ASX-listed, Australian-based financial services provider that specialises in acquiring and servicing retail debt portfolios, predominantly out of the major banks. We operate in a sector where traditionally about 80% of all volume has gone to 4 players. In recent times, that's changed, and Pioneer is now the second largest acquirer of portfolios out of those banks in Australia. Our business model is based around being differentiated in the way that we both acquire portfolios, but more importantly in the way that we service them, such that banks prefer us over others and sell to us because we're seen as a very safe pair of hands that protects both the customer and our vendor's brand. Pioneer's differentiated approach starts with the way that we acquire portfolios. Focused again mainly on the big banks, we do not acquire lower customer segments like payday loans, for example. Our business is really focused on the higher performing segments, customers with a propensity to heal, and those that we can genuinely help. We have a strong range of relationships across all of the vendors in the market, and something that's very highly respected by Pioneer and by those vendors, such that we're always included in their conversations about what portfolios might be available for us to invest in. Our disciplined acquisition of these portfolios is really underpinned by our analytics and understanding what is a fair price that we can pay for them, such that we can make a commercial return, whilst also, of course, providing a very, very secure and safe service to the customers that we service. Ultimately, our business strives to do one thing very, very well, and that is to do the right thing all the time. That is in the way that we treat our people, the way that we look after our shareholders, our vendors, and of course, our customers. One of the ways that we demonstrate our differentiation is through Net Promoter Score. Pioneer has a Net Promoter Score of +23 at our most recent look back, and it's an amazing testament to the service that we provide to customers that are having a tough time. Our compliance regime is very, very solid, and one of the things that differentiates this business from others. We're regarded and we're renowned for having a great offering that looks after our customers and also underpins the way that we represent the banks that we deal with. We have a board and a management team with extensive experience who are here to guide the business and also to protect shareholders' interests at all times. From a performance perspective, you'll see that over time we've had great performance that continues to increase. One of the very key parts of our business is our portfolio. We've invested almost $500 million over the course of the last few years, and we recovered some $700 million to date, with much more to go. Our portfolio has a value of about 1.9 billion Australian dollars in recoveries that are due to us. And whilst we won't recover all of that, we do have a performing arrangements book, almost like a performing loan book, of about $370 million today, and about $1.5 billion that we're working through with those customers so that they can perform, and of course that we can get a commercial return as well. In terms of the outlook for this business, there's a range of programs of work that are going on. Of those programs, it is about underscoring the validity of this business and why we are successful. And from there, it's about increasing the operating leverage and releasing that such that more of the profits flow to the bottom line. One of the key aspects of that is we're currently undergoing a refinancing to reduce the cost of funding, and it's a program of work that we hope to have cleared and finalised in the coming months. Finally, in terms of outlook, Pioneer has guided the market to an investment of $37 million. This is an amount that's less than we've invested in previous years, reflective of the changed environments caused by the pandemic. However, one that we expect to grow dramatically in the next couple of years. In terms of our earnings, we've guided the market to an amount that is an EBITDA of greater than $55 million. And a lot of that money is reinvested back into our business, into growth. We thank you for your time today. Hope you enjoyed the presentation and look forward to welcoming you as a shareholder soon.
We have moved into the exponential age where the pace of innovation and change is accelerating. The fact is, there are more technologies that are about to go to the mass adoption phase, groundbreaking, game-changing technologies than ever before in human history. And it's all going to happen over the next 5 to 10 years. And this is really quite extraordinary. My name is Monica Techer, and I'm the Chief Investment Officer at InSync Funds Management. Now, InSync is a future-focused specialist global equity manager that invests in a portfolio of highly profitable listed companies globally, benefiting from unstoppable and very significant long-term secular global megatrends. And what we're seeking to do is we're seeking to generate superior investment returns for all our investors. Now, our investment framework, which is depicted in this chart here, is really based on the foundation that over the long term, if you can find great businesses that can generate consistent growth in earnings year in, year out, this leads to a rapidly increasing share price, what we call compound returns. And our focus really is on identifying those really highly profitable, sustainable growth businesses or companies which are on that exponential path. Now, all our businesses need to have all of these key attributes in place before we invest. And that's why we call it the investment framework. It's not just one factor or another. All 4 factors have to be in place for it to be a successful, sustainable growth business. The first one is all our businesses have to be aligned to a global megatrend. And I'll talk a little bit about that a bit later. But that's absolutely fundamental to every stock in our portfolio. And in fact, quite often, many of our stocks have multiple megatrends that are driving it. The second key component is great to find businesses on a long-term trend, but they have to be highly profitable, because that is how you actually generate sustainable compound earnings growth over the long term. The third aspect is that they have to be what we say on the right side of disruption. We know disruption is a major issue today. A lot of companies are being disrupted negatively, and what we want to do is we want to find those businesses that are actually either agents of disruption, that are actually benefiting from the disruptive changes that are taking place today. And the fourth aspect is that they all have to be highly innovative. This is the theme of the conference that's going on at the moment, but it's absolutely fundamental to every stock that we own. All our companies typically invest somewhere between 40 to 50% of their cash flows on what we call R&D or innovative spend. And what this does is it ensures that they're on the right side of disruption. They're on the right side of what the next series of products that are going to be accepted by the market. And what it does is it actually future-proofs the business and ensures that they continue to stay on that mega trend. Looking for highly profitable businesses that are aligned to mega trends really gears the portfolio from our perspective to really generate high growth and getting a lot of economic value creation right across our portfolio. Now, we believe there are 3 exponential, really major exponential drivers that are really driving the exponential environment that we're moving into now today. The first one is the significant shift we're observing in demographics. Now, this is a shift that we've never experienced in our lifetime. I mean, there's so many changes that are going on beneath the surface, and you really need to understand those changes because they actually are driving demand for specific products and services. So if you can understand each of those generational shifts, there's a higher likelihood that you're going to find the winning businesses of the future. So if you look at the chart on the left-hand side, when people look at demographic shifts, there's always this focus on the aging population. And that is happening, and we believe is actually accelerating. And I'll take you to an example of a company we have in the portfolio that's benefiting from that aging population. But what's really insightful and interesting is that the number of young people that are making up a large part of the global population, over the next 10 years are going to be the Gen Zers. So this is anyone who was born after 1998. And within the next 10 years, they're actually going to make up the largest population cohort of all the different cohorts that are out there. So that 1.8 billion people. So it's really, really critical to understand what's really driving them. The second key driver, exponential driver, is really the multiple technological advancements we're actually observing today. So you can see here, the cloud, which we're all familiar with. It's really brought down the barriers to entry for a lot of new businesses, and they can scale very quickly and really increase profits at a rate that previous business models were not able to achieve. We've obviously got 5G, and that's now starting to accelerate. I would say 2020, 2021 were defining years for the increase in adoption of 5G, and this will deliver ultra high speeds with significantly greater bandwidth, really allowing a wide array of devices to connect to networks, facilitating the mass adoption of things like the autonomous cars and more effective responses, for example, in emergency healthcare. So it's really going to really speed, I think, things up very quickly and drive a lot of those exponential growth that we're looking for in the businesses that we're seeking to invest in. Another key component here is augmented and virtual reality, and that's really now taking off. And you're hearing concepts like hybrid working environment and the metaverse. What the metaverse is basically is a massive communal cyberspace linking augmented reality and virtual reality together, enabling avatars to hop seamlessly from one activity to the next. Now, I'm not going to go into a lot of that today, but if you really want to get an insight into that, look at Facebook's latest and newest metaverse product and how that works in a hybrid working environment. It's really quite incredible to see what's going to happen in the future in terms of hybrid meetings. And then obviously we've got the final key driver, which is the whole concept around sustainability and the move towards net zero emissions. So this is obviously alternative fuels like hydrogen, which has been around a long time, but there's a lot of work that's going into how can you effectively commercialize and create green hydrogen. And there's obviously the whole drive towards carbon capture storage and making that again much more economically efficient. And really the big driver though is the policy shift. These are great concepts, but you need to have an agent, a driver that's driving that exponential growth in that space. And that's obviously one of the big drivers is European Union. They're really committed to bring that down within the next 10 years as part of the Paris Agreement. And this is going to unleash trillions of dollars of new investment in that space. So from our perspective, they're really the three big exponential drivers, and perhaps just touching a little bit more on a couple of them, just to give you a bit more of an understanding as to how important they are. This is a chart of different expenditure depending on your generational cohort. And you'll see here that in 2020, the millennials, this is anyone born after let's say 1980 and 1998, in terms of their spending power, they actually took over the Generation X, which is my generation, which is anyone sort of born after between 1965 and 1980. But what you also got to see, what we call the post-millennials, so this is the Gen Zers, you can see that their spending power is actually starting to accelerate as well. And that's really important because going forward, if you're looking for businesses that are going to benefit from demographic shifts, really understanding the Gen Zers, for example, they're the first generation that have actually grown up with fully grown up in a digital age, and so their perspectives around consumption, their belief systems, are all going to be big drivers of products and services that are very distinct from the consumption patterns and belief systems that the Gen X's had. And I notice that all the time in my children, very, very different views in terms of what they look, how they shop for things, and their views on various aspects of life are distinctly different. And you've got to remember that it is this generation that's creating the future spending power, because as you get older, history clearly shows, the data clearly shows that we tend to spend less. Okay, so you really want to be catering to the millennial and Gen Z zeitgeist. Okay, you really need to understand what's driving them, and that's now taking off. As I said, the Gen Zers are going to be the largest cohort, so they're going to be really critical in identifying the winners over the next 10 years. The other emerging technology now, look at artificial intelligence. Has been around a long time as a concept. It was actually first coined in the 1950s by a person called John McCartney. So it's been around. The concept's been around for pretty much 70 years now, but it's only now taking off. And why is it only now taking off? That's the first reason is the computing power. We've just seen an incredible acceleration, both in terms of the speed and breadth of computing power that's available out there. So if you look at the fastest artificial intelligence supercomputer today, which is NVIDIA's 2.8 exaflop Selene. Now, an exabyte is equivalent to 1,000 quadrillion bytes. I mean, that's a big number. It's incredible. But that's what's really enabling artificial intelligence now to start taking off. Another key driver is big data. With a hyper-connected digital world, we're now creating more data now than we ever have, and it's growing again at an exponential rate. In fact, by within the next 4 or 5 years, by 2025, IDC, Intelligence Data Corporation, are forecasting they're going to have 10 times more data within 5 years than we had 5 years ago. Okay, so it continues to grow, and so when you've got companies like Amazon, what does this help companies do? If you look at companies like Amazon, they collect so much data on us as consumers that they can now accurately predict what our next purchase is going to be. Or Netflix, for example, can tell what subscribers what their subscribers are likely wanting to watch next. Okay, so it's just in terms of its impact on society, it's really going to be quite profound. And the other key component, obviously, of artificial intelligence is models and algorithms. And for big data to be effective, you need good algorithms. These are scripts that instruct AI technology what to do. So a really recent good example of all of this is obviously the impact of AI on COVID-19, which has accelerated the use of artificial intelligence in drug discovery. So an international team crowdsourced a COVID antiviral by synthesizing candidates for 2,000 molecules in less than 48 hours. So just sort of reflect on that point. Now, this process would have probably taken 1 or 2 months longer if it was just done by human researchers. So you can just see the speed with which things are moving around. So this is all part of that move towards the exponential age. These are all terrific, exciting, exponential technologies and growth drivers around. And the important thing here is, we're all excited by it, and but it's really vital to have a systematic framework to analyze and successfully invest in these changes, to identify the winners and generate the outsized returns I was talking about a bit earlier. Because without a disciplined framework, it is quite easy to get caught up in the hype and really lose significant amounts of capital. And this is what we do at InSync, that we try and stay away from the hype and really focus on and making sure we're very disciplined in working out which trends are actually going to deliver those consistent returns with lower risk. So I put this chart up here. It's an old chart. I think a lot of investors will be familiar with the tech bubble in 2000, but it's really quite instructive because, you know, we're seeing elements of that in some of the new technologies and exciting breakthrough technologies coming today. So, you know, there was a huge excitement in the 90s, as you can see here, in the technology stocks. These were the stocks listed on the Nasdaq. So this is a chart of the Nasdaq Composite Index going back to 1995. And you can see as we're leading into the late 90s, there was so much excited about the internet, despite the fact that there weren't a lot of companies that were actually very profitable. Yes, it was very exciting. We all knew it was about to take off. You know, everybody was talking about it, and share prices were bid up very, very quickly. So there was a lot of exuberance up there. But when the bubble burst, which is typically happens with a lot of hype cycles, then investors lost 70 to 80% of their capital. Okay? So it's just good to have this perspective in mind when you're looking at a lot of those new emerging technologies today. So one of the frameworks we use, this is the Gartner hype cycle, and it's a very useful framework to think about where the technology is in terms of adoption and profitability. Because as I said, you really want to try and avoid the hype phase. Now, you could get involved with that, but you've got to realize the risk and return profile is very different. It's much higher risk, obviously commensurate with higher return. But as I said, in the tech bubble, if you get it wrong, you can lose 70 to 80% of your capital. Sorry. So what you want to avoid is this section here. Okay, this is the hype area. So these are you know, technologies today like genomics or battery technology, even artificial intelligence to some extent sits in the hype cycle. It is very exciting. It is taking off, but it's still in the early phase in terms of identifying who the clear winners are. So we try and stay away from this area. And what we do is we focus, because a lot of these trends do actually end up becoming mega trends. So the internet started in 2000, but it took a full 15 years before we were really starting to understand or identify companies that were clear winners of that spend that we saw 15 years earlier. Okay, so some of these trends, genomics, artificial intelligence, will actually become mega trends. But if you're in the high phase, it's really hard to work out who the winners are. So you want to be past the high phase when there's a period of disillusionment. A lot of companies leave the industry, and the mega trend is still very much in place. But what you end up with is you start to get higher levels of adoption rates, and you start to find out who the winners are going to be. So, for example, we've recently invested in a leading player assisting older patients with non-invasive heart surgery. Okay? Now, this has been 12 to 15 years in the making. So this was very much at the innovation stage in the early 2000s. Adoption rates were very low. So we were probably around here in 2000. But when we look at it in 2020, the adoption, you know, that technology is now being commercialized, is being increasingly adopted, and companies are now trying to generate very high levels of sustainable growth. So from our perspective, when we look at it today, investing in the heart is a more assured way of increasing your wealth and health than in genomics today, even though genomics is obviously a very exciting technology. So megatrends. So megatrends is the core of really what we do at InSync. You know what megatrends are? They're very large, durable, and unstoppable, and in the right side of disruption. So you can almost set your watch by it. So if you look at the aging of the world population, the move to digital payments, or the drive towards improving health and fitness, these are not impacted by economic cycles. They just keep moving along just like a giant, colossal tidal wave. You know, they're unstoppable, they're large, and they just keep on moving forward. but we don't need to concern ourselves with correctly trying to forecast what the economic growth rates are going to be over the next 12 months to work out how to best position the portfolios, because we're invested in those profitable companies benefiting from these megatrends. So what we do at InSync is, it's about identifying the megatrends, it's evaluating the potential size of the next 10 years, finding the most profitable companies. I can double underline, it is so important. Great to find a megatrend, but you've got to find the economic beneficiaries of that trend, and correctly valuing them is really what we do in terms of finding the future winners. Okay, that's our competitive advantage. Now, what you'd observe looking at this chart, we've got 28 stocks across these 16 global megatrends, and there's a really nice combination of both technology megatrends. I mean, we live in a technological world where things are moving very quickly. Artificial intelligence, 5G, cloud computing, work automation using technology, augmented reality. So those data analytics. There are very profitable businesses that are on that exponential trend. There's exponential megatrends, but there's also a nice mix of non-technology megatrends. You don't to invest in future growth and secular trends and find highly profitable compounding businesses. You don't just have to be in technology. There's a lot of exciting non-tech trends here. So if you look at one that it's an important part of our portfolio is the pet humanization global megatrend, which is one where we're increasingly treating pets like humans. Now, interestingly, that fits in with the demographic shifts, because what we're seeing is we're actually seeing an acceleration in pet adoption and pet spend, and that's really principally been driven by the Gen Zers. So that gives us a lot of confidence, and the businesses that we own are just incredibly, insanely profitable. And so we're seeing the growth rates there at almost 3 times GDP. The amount of pet spend is actually growing at 3 times GDP. And we can see that happening for the next 5 to 10 years. The increased trend towards health and well-being. If anything, that's come to the fore of the global population is the importance of health. We're going through obviously a major crisis in COVID-19 here. So that's been a major accelerant. And then there's obviously the food away from home market. There's an increasing amount of food that, in terms of takeaway food that we've been consuming, and that actually, the amount of spend on takeaway has actually had increased at a level that's actually higher than the food prepared at home market. And this sort of happened 7-8 years ago. There's a lot of different drivers there, but that's a trend again that's been growing in multiples of GDP. And again, we've been able to find some outstanding stocks that benefit from that mega trend. So, in InSync's portfolio of 16 sort of technology and non-technology global mega trends, what that does do for the investor is actually provide some really powerful diversification benefits. A really useful place, in our opinion, to have in your portfolio. So, just to give you a couple of case studies, just to illustrate or give you ideas about what we've invested in the portfolio. So, again, a non-tech megatrend. So the aging population has been a concept that's been around for a while, but really one needs to understand how quickly the world is aging. So if you look at the bottom chart here, what you'd observe there is that the trend line in the over 70s is actually starting to accelerate. So yes, we know there's an aging population, but we're actually aging at a much faster rate today. And one of the, if you look at the top chart here in terms of the leading causes of deaths in the over 70-year-olds, it's actually cardiovascular disease. It's the heart disease. In fact, that's the leading cause of death generally, but particularly in older populations. You can see by a significant margin, it's the leading cause of mortality within that age cohort. Now, the real challenge there is that it's a really dangerous procedure to have open heart surgery in the over 70s. Okay, there's huge amounts of risk involved, and obviously with COVID-19, even getting to the hospital has been very, very difficult. So one of the technologies that's emerged, which I spoke about a little bit earlier when I was talking about the hype cycle, was a non-invasive procedure for heart surgery, which was used, which is called a transcatheter procedure. It's been 20 years in the making, and the company that we own there in the portfolio is Edwards Life Sciences. They're really one of the pioneers in the technology. And what we've seen is the adoption rate of that technology actually starting to accelerate. So here's a company that spends a huge amount of R&D, in fact, twice the level that its competitor does. It has, 40 to 50% market share. And as you see, as the over 70-year-olds cohort starting to accelerate, we believe that the demand for the product will also accelerate. And again, it's just a very, very profitable business. We measure it using a term called return on invested capital. So it's the amount of capital that goes on the business, and it's the return they get on all the capital that goes in the business. And across our portfolio, the average return on capital is 50%. Okay, if you compare to the average of the market of 10%, our portfolio in terms of profitability is 5 times the market average. So we're really, this is one of the 28 stocks we have in the portfolio. To give you another example, so this is, I suppose, more in the technology space. And 2020, 2021 was really a watershed here, a year for 5G. The number of licenses that were bid for in 2020 by telecom companies, telecommunication companies around the world was in excess of $100 billion to US dollars to get those licenses. And now they're starting to rapidly deploy the infrastructure. And what this will facilitate is the Internet of Things. So this is where devices connect with the network. So this facilitates obviously the autonomous cars or factory automation, or a much more efficient and faster responding healthcare system. So it really is going to be really quite incredible in terms of its impact it's going to have on all of us. And you can see from the bottom chart here that the number of devices that are expected to be connected as a result of 5G is going to double to over 40 billion devices just within the next 4 to 5 years. Okay, so again, the exponential growth is coming through, and again, we've got a number of investments that are going to benefit from this trend because we can see it happening today. It's accelerating. They're clear leaders in that space that we've identified. They're incredibly profitable, generate very high returns for capital. And so, we have a number of these investments that are really positioned to benefit from these trends over the next 5 years. And the important thing is we don't need to sell any of these stocks. They're, if you look at a company like Qualcomm, which is one of the companies exposed, they're the company that have basically created, the 2, 3G, 4G, and 5G platforms. So, if you want to participate on that, you've got to give them a license fee. And again, insanely profitable with a large addressable market to go into. So we're very excited about the 5G mega trend. And again, it's one of 60 mega trends across our portfolio. So as I said earlier, identifying the mega trends, evaluating the potential size of the next 10 years, finding the most profitable businesses and correctly valuing them, the select group of winners is really a competitive advantage. And you can see here, when you look at our performance numbers going back over, 1, 3, 5, and 10 years, as to the benefits of this approach. Okay, you can see you can generate very, 15, 20% returns is what we've achieved over the last sort of 5 to 10 years fairly consistently by focusing on the megatrends. And as we move into this exponential age, what we're observing is that many of the trends that we've had in place for a while pre-COVID, some of them are actually accelerating. And so we're finding those businesses that are going to be generating that significant earnings growth. And as I said to you earlier, if you can find businesses that can generate sustainable, significant earnings growth year in, year out over the next 5 to 10 years, then you get really, really attractive share price appreciation that follows that earnings growth. So please reach out if you would like to find more about InSync. And I really appreciated the time you spent listening to me in taking you through the investment approach to investing in the exponential age. So thank you very much.
Thank you for joining us for day 2 of Venture and Capital. I hope you enjoyed the session so far, and I hope you enjoyed the companies that have actually presented in this in the day to date. Now, following this, obviously we've got our special breakout sessions and we've also got our special meeting sessions. So this next component for the conference is all about networking with the companies that have previously presented, and obviously the ones which you've registered interest in and want to have a direct one-on-one chat with. Go into the platform, book a meeting inside Brella and have that discussion today. And the second part is we're obviously doing a live Q&A session called Market Movers with the small cap fund managers and investors, which is really designed to help you understand where they're thinking, what they're looking at, and how they're approaching these markets at the moment. So basically this next step for this day is all about engagement. The first part was all presentations and obviously the keynotes, the panel sessions, the speak. This next component's all about live Q&A, breakout sessions and engagement, and obviously you meeting face-to-face with the companies that interest you, that you want to learn more about as part of it. All that's taking inside Brella. Look for the breakout sessions tab. Also look for notifications of any meetings that have been requested with you, and then go from there. Now, that's it from me for day 2. Join us on Friday for day 3 of Venture and Capital. Yes, we've got a 2-day break. We've got 2 days of actually activities for founders, but don't worry about that. That's not for you. Join us on day 3, where we're going to be focusing on the hottest subject right now in the markets, and that is everything digital assets. So crypto, DeFi, decentralized finance, and NFTs have literally just taken over the conversation, especially after this latest bull run over the last couple months, and really the returns that investors have been seeing for the last 18 months. You know, we're fortunate enough to have some of the top fund managers, not just from Australia, but also from around the globe, as companies that are participating in this. As an investor, this day is not to be missed. This whole area of digital assets, the adoption rate is absolutely phenomenal. And in fact, they've been showing that the adoption of digital assets is taking place at a rate of almost twice as fast as what the internet adoption was, to give you an idea. There is a massive exponential opportunity coming up. So what's important for you as an investor is to learn from the guys that are actually, they spend literally 24/7 focused on this area. So this is not about hype. This is about understanding the space, understanding what drives the markets, and understanding what is the opportunity over the next decade in the digital asset space. So, and also decentralized finance and NFT. So join us for day 3. You are absolutely going to love it. So if you love day 1 and day 2 and everything we've provided so far, day 3 is a whole other level. Look forward to seeing you then.